First item for our consideration is a review of sales and use tax continued.
We need to do roll call, Troy.
Yeah, let's do roll call. Last time I did roll call on the second day, I was admonished that it wasn't needed. This time we'll do it because I'm being admonished for not doing it. Let's do roll call.
Senator Case. Senator Ide.
Here.
Senator Pappas.
Here.
Representative Brown.
Here.
Representative Campbell.
Excused.
Representative Lean.
Here.
Representative Lucas.
Present.
Representative Riggins.
Here.
Representative Storer. Representative Stivar.
Present.
Representative Wharf.
Here.
Co-Chairman McEwen.
Here.
Chairman Locke.
Present.
All are, Mr. Chairman, you have a quorum.
Mr. Chairman, Mr. Co-Chairman, members of the committee, Brett Fanning, Director of the Wyoming Department of Revenue. Mr. Chairman, you did give me some homework last night. If you want me to briefly go over that, I'm more than happy to. Just let me know, or unless you'd like to discuss that privately, and then we can talk about our sales and use tax distributions.
No, let's go through that quickly, please.
Yes, sir. All righty. There were two topics that really came up yesterday related to the data centers, and it was an important discussion, and I did receive a lot of feedback, albeit in 12 hours on that discussion. So a lot of good feedback, a lot of good discussion. The first portion of that is the property tax. So we need to be clear on this. For the property tax element of the data centers, there are no exemptions. There are no exemptions for the property tax related to data centers. And I think that's important to clear up. As we all know, all that property tax goes back to our local communities. That's the main part of it. When I was talking with Administrator Gill on getting those figures, that is something we're going to have to get back with you on. The reason being, we want to make sure that when we're running our queries, we're including the correct abstract codes so that we can get you the dollar amounts that are more applicable. Yes, it is in the millions of dollars. That is what we know. We just want to make sure we have those tied down so that you can make informed decisions related to that property tax piece.
Senator Ide.
Thank you, Mr. Chairman. Just real quick, what method of valuation do they use on those data centers? The market, income, replacement cost approach? Can you answer that? Thank you, Mr. Chairman.
Mr. Chairman, Senator Ide, I'm going to phone a friend, so I'm going to have Administrator Gill come up. Very well.
Mr. Chairman, Ken Gill, Property Tax Division, Department of Revenue Administrator. Senator Ide, your question was, what method of valuation do they use on these properties, these data centers? So most of the property that the data centers have is personal property, business personal property. And if you remember last session, we had quite robust discussions about personal property and how the company reports the value or the cost of that asset, if you will, maybe a computer, a server, whatever it may be, and then it is trended to today's dollar and then depreciated. Now, most of the assets in these data centers have a lifespan of 6 years at the most, and that's a depreciation schedule that the assessors are using currently. We know in practice that most of this personal property is replaced every 3 to 4 years. So we're trending and then depreciating.
Thank you, Mr. Chairman. Quick follow-up. As far as just the land itself, can you speak at that as well?
Mr. Chairman, Senator Ide, yes, the land would be at market value. So they're going to value the land at a market value using sales comparison approach, something similar like that, based on sales that happen with other commercial type properties. The other real property, the improvements, they're going to probably be using a cost approach to value, replacement cost new, less depreciation on those assets. If you've ever been to one of these campuses, the buildings are very, very large, and then they have a lot of outdoor facilities also, large, and lack of a better term, canopies that are very long with server stations sitting underneath those. So a cost approach, more than likely.
Co-chairman. Locke. Okay. Whoops.
So sorry, I'm just gonna, quick clarification. So they're paying, there's no exemptions on any real property, improvements to real property, or on their personal property. That's all. They pay property tax on all of that. And there's no exemptions mixed into that. I just wanted to verify. I think that's what you said. Just wanted to be sure. Thank you.
Mr. Chairman, Co-Chairman, yes, that is correct. When you look in Title 3911-105, there are no exemptions for the personal property or the real property of data centers.
Please continue.
Thank you, Mr. Chairman. Stay here, Mr. Administrator Gill, you never know. Okay, so on the sales tax piece of this, as I testified to yesterday, the last time that we had surveyed the data centers, that figure was $22 million. That was tax foregone or unrealized tax revenue. That was that figure, 22 million. We didn't receive responses back from all of our inquiries related to those data centers, but we know that it's at least 22 million at least 2 years ago. And it was interesting because when I was going back through our surveys and trying to tie the actual sales tax figure to those is a challenge, but that's what we knew 2 years ago. So on the sales tax piece, and I did go back through every data center account that we have in our system, and it's really hard. It's really challenging to tie down that figure other than what was reported on it. We knew it was 22 million, but we also know that data centers are also purchasing consumable items, not computer equipment, where they may be paying sales tax to a local vendor, a local store locally in their communities, or it's possibly an online or out-of-state vendor, and that data center needs to accrue tax on non-computer related and non-backup power supplies. We know those happens. And I did look at returns. There is use tax that is being accrued and charged to themselves on items from these data centers. Mr. Chairman, I did go back through several of our exemption surveys over the past few years. So from calendar year 2010 to calendar year 22, that average was 15 million a year in tax foregone on reported data center purchases. Again, that was really early in the time frame of data centers. And so I did also look at calendar year 2017 through 2022, the last year. And so it did increase to 19 million in tax foregone. And so we did spend collectively several hours last night trying to tie down that sales tax piece. And it was amazing. It was actually Administrator Ream. She actually gave me an outstanding idea on when these data centers are being built. And I had one sentence on this yesterday, but when these data centers are being built, there's a lot of construction that is happening with these data centers. Outside of computer equipment, outside of power supplies, they're building buildings and they're putting in all the infrastructure that's necessary to implement those data centers into production. And so what I did is I I've mentioned before, we do not license contractors. So if you're working on real property, don't need to get into that for this discussion, but if you're working on real property, you don't have to come to the Department of Revenue to license. Unless you hire out-of-state contractors. If you start hiring out-of-state contractors, there are statutorily reporting requirements that come through the Department of Revenue. Okay, well, I was like, there's likely some out-of-state contractors on these projects. So I pulled up a ton of our projects that we have related to data centers throughout the state of Wyoming, primarily in the southeast corner. And when the group yesterday was discussing billions of dollars in projects, our system also highlights that amount of revenue that is being generated in contracts that are coming through the Department of Revenue. Now, as I just mentioned, those contracts that are in the hundreds and hundreds of millions, a lot of that is work to real property, not sales taxable. But there is a piece where a non-resident contractor, subcontractor, has to report the tax on their materials. And those figures were material as well. I was looking at a multi-$100 million contract, and there was $15 million in materials. And you start taking tax rates on that and adding up all those, then you really start to get into some material sales tax figures. Property tax all goes locally. Sales tax, the distribution, which we're going to talk to a little in here in a few minutes, is a little different. It varies based on local pennies, but basically half goes to the state of Wyoming, half goes back to the local share. So the sales tax piece, in addition to the tax on the electricity that they're paying, but there are material sales tax figures, and I can, Mr. Chairman, it was difficult for me to do remotely, but I can start doing some of that analysis. As Administrator Gill said, he was willing to have his team and our local partners look into the actual full impact of the property tax element. Then I can come over on the sales tax piece, start adding up sales tax on materials for some of these projects, and then see where we come out. I think that is doable, but I do know this is in the millions of dollars just based on a few hours of analysis last night. So and with that, Mr. Chairman, I'm happy to do that. I can write it down. Thanks, sir.
Please do.
Thanks.
Okay, so what are some of the other exemptions? Can we move on?
Mr. Chairman, yes, sir. The data center exemption was the focus of my homework last night.
Let's roll into the next topic then.
Thank you, Mr. Chairman. Ms. Eve and LSO, can you assist? So the next topic, thank you so much, is this presentation, Wyoming Sales and Use Tax Distribution. This is a topic that is really interesting, and it kind of goes to what we were discussing here just right quickly. If you want to go to the next slide, please. All right, slide 2. This is one that's fascinating, and I know a lot of folks like looking at this. Does everyone know what their sales use lodging tax rate is in their community? And if you don't, that's okay. That's why we're here to discuss this. And so as you can see in Wyoming, generally the sales tax rate is going to be between 4% and 6 to 7%. And I'm going to go through a couple of examples where that's a little different now, but generally most of your communities, all the communities, you're going to have between 4 and 6%. Let's go through a couple of them. Right now, Natrona County is a very fascinating and unique example. It was mentioned yesterday that the city of Casper did put on the ballot and pass Wyoming's first municipal option sales tax. And so if you are within the city of Casper city limits, the combined sales tax rate is 6%. And I'm going to go through the breakdown here in a sec. If you are outside of the city of Casper city limits, so you're in Mills, Evansville, Bar None, somewhere out in Natrona County, it's still 5% as it's been for as long as really anyone can remember. But it varies throughout the state. For sales tax purposes, statutorily, you have to have at least 4%. That's a 4%, and we're going to talk about that here in a few slides. After the 4%, the rest of these sales tax pennies are voter approved. Okay, so for example, just Albany County, because it's on the top, it's got the mandatory statewide 4%. It's got a general purpose, and then it's got a specific purpose, total of 6%. If you go down to, and again, I won't go through every one of these, but you can start to see that all of our communities are different. And some communities have voted in voter approved pennies while others haven't. Currently, right now, obviously there's 23 counties that have at least 4%. We have 21 out of 23 counties, so the majority, have a general purpose tax, commonly referred to as a fifth penny. Now, I know we're having that discussion a little later as well. That nomenclature is a little different. There's more pennies now. So again, generally, general purpose is the fifth penny. 21 out of our 23 have a fifth penny. Currently, right now, Park County and Sublette County do not have a fifth penny. Then we go down to the specific purpose. These are, again, voter approved pennies and generally voted upon by the general voting public for specific items. And each one of your communities, or at least the majority of them, are going to have some sort of specific purpose. Or let me rephrase that. It's actually been updated. The past few election cycles, there have been communities that have actually dropped their sixth penny for whatever reason, or additional pennies on here. So it's no longer the majority of Wyoming counties have a sixth penny. But like, for example, my community, Laramie County, just like Albany, has a sixth penny. Specific purpose is generally referred to as the sixth penny, just in general. We do have one community that has an economic development tax. We used to have two, but no longer. It is just one, that's Goshen County. They have a quarter penny that goes for economic development. And there is some statutory guidance on, air quotes, what economic development is. Okay, the next column over, the municipal option, again, we just have one so far. I have received several inquiries related to other communities looking at municipal options, just primarily based on the amount of revenue that the city of Casper has generated over 2 months of distributions. And then we've got a total column. This topic doesn't cover lodging tax. Mr. Chairman, if it's okay, I won't go through it, but it does come up in our slides later on. But there are two portions of a lodging tax as well. So, Mr. Chairman, I think just for time, maybe we'll just stick to the sales and use tax portion.
Representative
Next slide,
Ward.
please.
Excuse me, yes, Mr. Chair. I noticed you skipped over the resort district tax. Can you explain that for me, please?
Please.
Thank you, Mr. Chairman. Mr. Chairman, Representative Worf, thank you so much. Should not have skipped over that. The resort district tax is a tax that, as of right now, is only found in Teton County. And so Teton County, a resort district, is defined as an area that has less than 500 people, has really no manufacturing or industry, but's heavily dependent on tourism. That is what a resort district is. So we've got two of them in Wyoming, both in Teton County, Teton Village Resort District and Grand Targhee Resort District. Those are our two resort districts. So right now, if we all go out to dinner in Teton Village or Grand Targhee, Teton County is unique as far as sales tax piece. Again, resort district, we're in Teton Village Resort District. Teton County also has our only second specific purpose tax. So if I go anywhere in Teton County, not in a resort district, I'm going to pay 7% sales tax. It's our highest tax rate in Wyoming right now. Then if I go into a resort district and have dinner, there's an additional 2% on that meal. So if I have a meal at one of the resort districts in Teton County, I'm now paying 9%. So though that is our highest rate in Wyoming, and it is isolated currently to Teton County. I've done analysis. I do think there are other communities that would technically qualify and meet that statutory definition as a resort district, but right now they are just found in Teton County. Thank you.
Representative Lean.
Thank you, Mr. Chairman. Director, could you please refresh me on where the lodging taxes end up, which account they deposit into?
Mr. Chairman, Representative Lean, outstanding insight. It's in my presentation. Okay. All right. See
Let's
if there's-
continue.
Thank you, Mr. Chairman. Okay, next slide, please. All right. And we can go to slide 4 as well. Okay, here's the breakdown of sales and use tax distribution. So remember, we've got the statewide 4%. Every county has to have it. It's broken down really into two pieces. Okay, the state gets 69% of it. That's been discussed, obviously, in the past few months and over the past legislative session. Then, so there's 31 remaining percent. An additional 1% goes to the state general fund for the Department of Revenue administering that, those taxes. Department of Revenue does not get that 1% administrative, it goes into the general fund. So then, in the most simplest of terms, the remaining 30% gets distributed back to our local partners, for simplest of terms, on a population formula and where the sales are generated. So that's the statewide 4%. Some of it goes to the state, 69, I think it's 69.3 is really how it works out. And then the rest goes to our local. The general purpose, specific purpose, economic development, resort district, the municipal option, there's a 1% administrative fee that goes into the state general fund. Again, it doesn't go to the Department of Revenue. And the rest of it goes back to our local partners. Next slide, please. This is just a different way of saying exactly what I just said. You've got collected tax, you've got the statewide 4% on the left, 69% goes to the general fund, and then the same percentage over. Just an exact different way of saying what I said with the pie chart there. Next slide, please. Okay, we've gone over this one as well. This is how that statewide 4% gets distributed. 69% to the general fund. There's a 1% admin fee from the remaining 31%. Okay, the reason I am, so there's another 1% that comes out of that 30%. It still all goes to the local share. All goes to the local share. But I don't want to confuse this 1% with other conversations that are going on with different distribution formulas. But there is a guarantee from the statewide 4% where $40,000 annually of the sales tax goes to our counties. And then they also get $10,000 annually of the use tax. That goes to the counties. Okay? And then with the remaining percentage, then it's distributed based on a population formula. So I don't want to really get into the weeds on this one unless there are questions, but really the total message from this slide is 69% is going to go to the state. There's a 1% admin fee comes off, and then the rest goes to our local communities based on population and where the sales. Sorry about that, Mr. Chairman. Technical difficulties. Okay, the general purpose tax. This is one commonly referred to as the fifth penny. There's a 1% admin fee that goes to the state general fund for DOR to administer this. And then the rest of the fifth penny goes into the distribution formula based on population. And next slide, please.
Director,
Yes, sir.
so there's an additional 1% that comes out of sales tax that goes to the county? I'm having difficulty with this slide. So it's actually 2% that come out of the top.
Mr. Chairman, thanks for allowing me to clarify. If we go back to slide 3, please. Okay. So, Mr. Chairman, on this one, we're no longer dealing with the statewide 4%. This is all locally voter-approved pennies. The state is only getting 1% of this 1% that was voter-approved. So this 1%, the local entity is going to get 99% of it. This is all voter-approved pennies. But yes, the state does get an admin fee for administering the locally approved pennies.
Excuse me, Director, on slide 6, it says deduct another 1%, distribute the remainder of this 1% to each county. So where's that 1% coming from?
Mr. Chairman, thank you so much. Yes, these are all different buckets on this one. So yes, of the statewide 4%, before we send money to the counties, the state does take 1% of that. There was 31% remaining. The state gets another little portion of that to go to the state general fund, cost of administering the sales tax on this. Then if we move out of a bucket and go into voter approved penny, the state does get 1% of voter approved pennies as well. So I think the answer to your question is yes, the state does get administrative fees for some of these buckets that we're distributing.
Okay, thank you. Representative Lean.
Thank you, Mr. Chairman. Director, can you tell me, are there any restrictions on that fifth penny use? Or is it per what the voters decide on the ballot? Are they counties and municipalities held to spending the money in that manner?
Director.
Thank you, Mr. Chairman. Representative Lean, yes, there are some obligations that are outlined in statute on how that money can be spent. And let me make sure I make a note that I can get that for you.
Go ahead, Director. Oh, excuse me. Representative Locke, Co-Chairman Locke.
Thank you, Mr. Chairman. So I apologize, directors. I guess I'm the one who's a little thick here. So on slide 6, there's the deduct 1% admin fee to the general state fund. But the next bullet down, can you explain the deduct 1%, distribute 40,000 annually? That was a piece I did not fully appreciate. I guess I missed it, or I don't know, because I see these are kind of at the high level. You got your 31, your 69, and the additional 1% of the 31 that goes to the admin fee. I get all that. But what is that, deduct another 1%, distribute 40,000 annually in monthly installments? What is that part of that slide? I didn't understand where that's coming from and what that is. And if I'm kludging the conversation, let me know. Thank you.
Director.
Thank you, Mr. Chairman, Mr. Co-Chairman. Yes. So in the local portion of the statewide 4%, there is a county guarantee model built into it. This is outside of conversations they're having with big direct distribution figures. This is just the statewide portion of our sales tax. There are county guarantees in there. where no matter how much money they've generated in sales or use tax, a county is going to get these figures each year. Then what's remaining, then we come back and distribute just like we do based on population.
Representative Lucas.
Thank you, Mr. Chairman. Director, just, I'm curious, the 40,000 and the 10,000, the flat dollar amount distributions, is that a material amount to some counties then, so that they're guaranteed a specific amount that's material to them?
Go ahead, Director.
Thank you, Mr. Chairman. Representative Lucas, yes, absolutely. There are some counties where every taxpayer dollar is important. It absolutely is. There are some counties where that is not material at all. There are some counties where that is, I would say, in looking at the figures, vitally important. Absolutely, yes.
Okay, Director, let's continue.
Thank you, Mr. Chairman. If we could go to slide 8 then and discuss the specific purpose. So again, this is a separate bucket than what we've already talked about. Statewide bucket over here. Fifth penny general purpose over here. This is the specific purpose over here. This is a voter approved penny that goes on the ballot to pay for specific items. And so we generally, most of your communities, you're going to see it where you've seen it. Hey, we want to fund XYZ project, fill in the blank. And communities can say yes or no to certain projects. And that actually happened recently with the Casper municipal option. But these are specific projects on the ballot. Some are yay, some are nay. The state does its 1% admin fee because for administering that tax. And then this comes back to the county to distribute then to the local partners for those projects. This is a question that I always get come up, especially when we're talking about exemptions or talking about taxing certain things. This is one that goes to the county treasurer, and that's where it leaves the Department of Revenue. Now, how it was voted on by the community, then the county treasurer is the one who distributes it to the correct entity. So like, for example, in Laramie County, we have specific projects that maybe go to the city of Cheyenne, town of Albin, town of Pine Bluffs, etc. We send the money for specific purpose taxes to the county treasurer, and then they distribute it out to the correct entities. Let's see, there is a,
Director.
sorry.
Senator Wright.
Yeah, thank you, Mr. Chairman. Real quick, you mentioned that there was restrictions maybe on a general purpose tax. Is there restrictions or anything in statute on a special purpose tax for, like, for instance, the 6-cent tax in Natrona County or in Casper? Thank you.
Mr. Chairman, Senator Ide, yes, there are. And I will include that in my request as well. Thank you, Mr. Chairman. Last point on this one, there are some provisions in statute to keep some of this money as a reserve, just in case there are refunds or overpayments or amended returns. These happen. Taxpayers are primarily vendors. Maybe they don't charge the right amount of tax and they've got to amend returns, or they charge too much and have got to amend returns, or a taxpayer provides an exemption certificate within a few years. All of these things that change our distribution really on a nightly and then a monthly distribution basis. There are some provisions in statute to, hey, make sure you have some money in there just in case there's an amended return that changes your future distribution. Okay, slide 9, please. This is where we start talking about local lodging taxes. And on the local lodging tax, there's two pieces to our lodging tax. There are. So if I stay at a hotel here in Natrona County, Generally, let's look at our tax rate sheet. I should be charged 12%. I'm going back. Okay. 12% in Natrona County. I'm not in the city of Casper. That lodging tax is broken down into two pieces. There's now a mandatory statewide 5% lodging tax. That 5% is generally broken down, my apologies, into two other pieces as well. Part of that 5% is going to go to our Office of Tourism. So 3% is going to go to the Office of Tourism. The other 2% of that 5%, my apologies again, distribution is one of the most complicated things. It just is. 2% of that 5% is going to go back into the community and distributed back to the community that generated it. So remember, we're here in Natrona County, 7%. In one bucket, we've got 5%. Within that bucket, there's a 3% that's going to go to the state Department of Tourism, and then there's 2% that's actually going to go back locally. Okay, that's that 5%. Then counties have the ability to vote on locally approved lodging tax pennies as well. Not all communities have. Some do, some don't. Here in Casper, it's an additional 2%. And it's important to note that local approved lodging tax is capped at 2%. I won't get into that dialogue unless we want to, but it's capped at 2%. So you've got two primary buckets, a statewide lodging assessment and a local voter approved penny. And then for the local approved penny, again, it's in this different bucket over here. 1% goes to the state for an admin fee, and then the rest goes back into the local community that generated it. And lodging tax is actually a little different as well. If you were to go back to a slide, you don't have to pop back to our tax rate slide, but there are provisions in statute that allow local communities to actually implement a local lodging tax. So you will see there are 5 counties in Wyoming where individual towns or individual communities have their own lodging tax, and it goes directly back to them, as opposed to a more county-wide lodging option where then it's based on is the hotel inside or outside of a municipal boundary. I know that part's really confusing. It's important to note, thank goodness, and thanks to Administrator Ream as well, the full implementation of the statewide lodging, the 5%, we've fully implemented it as of July 1, 2025. The last county to fully implement it, and again, it was based on how it was in legislation, when things appeared on ballots, but the last county to fully implement it was Campbell County. So any questions related to that lodging tax piece?
Let's keep going, Director.
Thank you, Mr. Chairman. Next one, resort districts. Again, we kind of outlined these are very unique in Wyoming. There's only 2 spots that have them. There's the 1% that goes to the state for an admin fee, and then the rest goes back to that jurisdiction.
Representative Worf.
Is that a voter approved tax as well? I noticed that you referred to the others as voter approved. Is that a voter approved tax?
Director.
Mr. Chairman, Representative Worf, I'm going to get back to you on that one because it is a little different, and I think there's a little more community involvement. Maybe one of the legislators on your committee may have some more insight at their fingertips than I do.
Okay, and then as a follow-up, I'm assuming that it's also for a dedicated specific purpose, or is that just goes into a pot and it's spent however I don't understand the distribution. I mean, it just says it goes into an account and then it goes back and it doesn't say, is it specific to a specific purpose that it's raised, or is it just a tax like any other tax?
Director.
Thank you, Mr. Chairman. Representative Worf, yes, there are provisions, and there's a lot of provisions in statute that outline what you can and can do with those taxes. And I'd be happy to get that to you as well.
Thank you.
Sir. Okay. Let's see, next slide, please. Slide 11. Here's the economic development tax. Again, 1% admin fee goes to the state. And then the remainder of this really mirrors to some extent kind of that general purpose. It's going to be distributed to communities based upon a population. And it does have some additional provisions in statute on what it can be used for as well. So yes, again, there's now only one community that has an economic development tax in Wyoming. That, Mr. Chairman, that brings something to mind that's probably important to note as well, is the voter approved pennies. So generally you're talking about your general purpose fifth penny, your specific purpose sixth penny, and your economic development tax. Statutorily, those are capped at 3 pennies. So the communities can only voter approve up to 3 of those pennies that I just outlined. So like, for example, we just discussed Teton County. They've got a 5th penny, a 6th penny, and they've got a specific purpose as well. Okay, so technically you can have up to 3 pennies on any of those flows. Next slide, please. Next one, municipal option. Again, this is really new to Wyoming. We've only distributed twice now. It started April 1, 2025. Again, there's that 1% admin fee that goes to the state, and then the remainder gets sent to the jurisdiction that imposed or voter approved that tax. And in this case, it is City of Casper is our only one. Okay. Next slide, please. Okay, I think that's it.
Representative Lean.
Thank you, Mr. Chairman. When you say voter approved, Director, are you talking about the local municipality is approving this optional tax, or are you putting it on a ballot?
Director.
Thank you, Mr. Chairman. Representative Lean, it does go on a ballot. So if you had lived in the City of Casper on the November 2024 election, it was on your ballot to approve those specific purposes.
Senator Ide.
Thank you, Mr. Chairman. Yeah, real quick, you know, that ballot, 5th Senate, it's optional too. It's got a 4-year, you know, sort of a time window on it. Can those be made permanent? Not that I want that, but I'm just curious. Thank you.
Mr. Chairman, Senator Ide, yes, they can. There are provisions in statute that would allow that.
Let's roll on to the next topic.
Mr. Chairman, Josh Anderson, Legislative Service Office. This part of the agenda was a review of the 5th and 6th cent statute. You've already heard a lot of what I was going to say from Director Fanning's excellent presentation there. So I'll just reiterate a couple of points. Of course, as we all know, the statewide rate is 4%. And then so there's these optional pennies that can be voted in. Specifically at the county level are the ones that are generally referred to as the 5th and 6th penny. As Director Fanning noted, that's a bit of a misnomer. They can do up to 3% additional from these three general types of optional taxes. They can do a 2%, up to 2% for general revenue. But generally, almost every county does 1% for general revenue, and that's commonly known as the fifth penny. There can be up to 2% for specific purposes. And again, usually 1% of that is commonly called the sixth penny. And then there can be up to 1% for economic development. But then those are limited to no more than 3% for any combination of those three types of taxes. Representative Lean had asked about the distribution of the fifth penny. That generally goes into the general fund of the entity that's imposing that, and then can be expended in the same manner as other general fund revenues. There can be limitations on that. A portion of that, if listed on the ballot, can be designated for economic development, and then it would be just restricted to be expended in that manner. Representative Ida asked about the sixth penny, the specific purpose, and that's required to be used in a specified amount for the specific purpose that is authorized by the elector. So that would be both the amount and the purpose would be listed on the ballot, and it would be required to expend it in that manner. Yeah, Mr. Chairman, like I said, otherwise, I think Director Fanning pretty much covered everything I was going to address. As I noted, all but 2 counties impose that at least the 1% general purpose tax. Those are park and sublet counties. And then we do have the first county, as was noted, that is now over that 6% and is at the maximum 7% additional optional taxes, Mr. Chairman. So I don't know if you have any specific questions, but.
Representative Locke.
Thank you, Mr. Chairman. And when it comes to that special purpose tax, for example, obviously it's lined up. We got projects 1, 2, 3, 4. When those projects are funded at the level the voters approved, can you walk through kind of the process or the procedure for that tax, for lack of a better term, going away? Can you walk through that just a little bit?
Yeah, Mr. Chairman, the statute does provide that once the amount that was indicated on the ballot is reached, that tax would automatically come off the books. I think they need to notify the department that it's done, but it would essentially is required to automatically stop once those amounts are reached.
Thank you.
Thank you. Any other questions? Any other questions? Any other questions? Representative Lean.
Thank you, Mr. Chairman. Thank you, Mr. Anderson. My question comes about the sixth penny and how is that administered? I'll give you an instance. My district covers both rural and city, and Casper recently approved a sixth penny, but my rural voters did not vote on that. But when they order items to their home, because their zip code is the same as my city portion, they're now being charged that sixth penny. So my question is, how do we administer that? Is it geographical or is it by zip code?
Mr. Chairman, I might phone a friend to Director Fanning if I could.
Mr. Chairman, Representative Lean, yes, this is a challenge. It's not based on zip code. The way the statute's written, it's based on that geographical boundary. And so, for example, when I was going around illustrating how this would happen, yes, if there is a pizza restaurant that is inside the municipal boundaries of the city of Casper, that one's pretty easy right now, 6%. Okay, I go into the city of Casper and or went to an amazing restaurant right now or last night, downtown Casper, charged me 6%. If that company inside the boundary delivers to another community outside of the municipal boundaries, then they've got to just charge the Natrona County 5%. Yes, this gets complicated. Then let's just say that you have an amazing business outside of the city of Casper, Mr. Chairman, Representative Lean, and then they deliver to a customer that actually lives inside the boundaries of the city of Casper. Even though they're outside the city of Casper, sorry for the third time, they've got to charge the municipal option. The reason why is because outlined in statute, it's where the customer takes possession of the item. That is where sales taxability is sourced. We kind of get into that a little bit, I think, in my next memo. Where the customer takes possession. That's the primary factor and is outlined in the streamlined sales tax agreement. If you are, or anyone really, anyone in your communities that are being charged tax in error, please let me know. And I've made this, and numerous people have reached out to me, and I encourage it too. We want to make sure that we get this right. Yes, if you did have someone who lived outside the city of Casper, but goes into Casper because that's where everything is that you need to buy, they are subject to those laws, even though they did not vote on it. Again, it's where the customer takes possession of the item. This is not really any different to if I go to a neighboring state, I'm subject to their laws as well. So it is. This is something we're navigating. And again, I have not completed all the pieces. Let me say it a different way. We are still working through those complexities with the city of Casper's boundaries. That being said, there needs to be a huge kudos given out to the city of Casper on this. They have updated their website that actually includes a boundary, and you can put in that address and see if it's actually in the municipal boundary. There are some very unique addresses where you'd think they'd be in the city and they're not, and vice versa. We all know how the boundaries of our communities work. They're not a perfect rectangle. So yes, kudos to the city of Casper for helping the Department of Revenue in administering this municipal option tax.
Mr. Chairman.
Senator Case.
Thank you, Mr. Chairman. I wonder if Mr. Fanning's ever been to a restaurant that was not amazing. But no, actually, I was hoping Mr. Fanning would talk just a moment about the special challenges of imposing taxes on my district, which includes the Wind River Indian Reservation, and kind of the challenges we have with collection and distribution there. And the Tribal Relations Committee has explored some solutions, but there certainly is instances where tribal members are being charged for taxes for stuff that's mailed to their homes that probably is inappropriate. And Mr. Fanning, could you maybe shed a little bit more light just for a moment, Mr. Chairman?
Director.
Mr. Chairman, Senator Case, yes, absolutely. That was a topic in the Tribal Relations Committee for several years. And I do miss that it's not a topic anymore, because the community members, they were fabulous to work with. There are challenges. So remember, I just told you it's based on where the customer takes possession of the item. So you purchase something from a large online retailer and you have it shipped to your home on the Wind River Indian Reservation. Okay. I outlined yesterday that if you are selling an item to a tribal member on the reservation, that's not subject to sales tax. But what if the exemption certificate portal system for that online retailer is not user-friendly as maybe it should be, or it's difficult to navigate, or for whatever reason, a tribal member did not put an exemption certificate on file with that company? Per our laws, they've got to charge the tax. They're supposed to charge the tax. All retailers charge the tax unless they're told otherwise. That's usually an exemption certificate. Well, but there's a valid exemption there, right? They just weren't able to provide the certificate for whatever reason. And so how do you navigate that tax that was charged in error? A couple Couple ways we've done that. I made the exact same ploy to the Tribal Relations Committee for years, saying, please, if you're being charged tax in error, I can help. And how I can help is I can reach out to those vendors and in collaboration with the actual taxpayer and say, let's work together to get you that exemption because it is valid. But that's a challenge, right? It's intimidating to ask the Department of Revenue for help. I understand that, but I try not to be, and I'm more than happy to help. So there are challenges with online retailers who are shipping into the Wind River Indian Reservation. There's also a challenge on the other side of this coin. Say, for example, I'm not a tribal member, but if I were, say I go into one of the surrounding communities of the Wind River Indian Reservation, whose laws am I subject to there? Kind of goes to that jurisdictional question. Remember, if I purchase something on the reservation and I'm a tribal member, it's exempt. There's no question. I outlined it yesterday. But then if I come into a surrounding city, Riverton, DuBois, Lander, Thermopolis, and there's others, how does that exemption work? Remember, now I'm off of the Wind River Indian Reservation, and now I become subject to what I would call the normal taxation situations. But that's a challenge because tribal members, remember, generally have exemptions in a lot of areas. And then what happens if you have retailers who don't have an exemption certificate on file, and then they come under audit? And so there's just those challenges, those jurisdictional challenges. But again, Senator Case, please, Mr. Chairman, Senator Case, if your constituents are still having those considerations, let me know. There's also discussions to be had about utilities, right? I'm a public utility company and I'm providing that electricity on the reservation. Is there an exemption there, right? Or if I have a cell phone, right? I have a cell phone. Hopefully you don't have a flip phone, but say you have a cell phone and you're on the Wind River Indian Reservation and you're a tribal member. Is that subject to the same sales tax as the other folks in Fremont County? A lot of challenges there. But again, for the third, fourth, fifth time, I'm more than happy to help if anyone in Wyoming is being charged tax in error.
Representative Locke.
Thank you, Mr. Chairman, and I want to thank the people who asked these two questions because you really brought up an interesting point. So there's really two conditions here, and the reservation was a good example where they're exempt. In this other case described by Representative Lean, this appears to be a case where those large online vendors may be applying a tax based on zip code versus a boundary. Is that a true situation? They'll just choose one of the online vendors, and now they're people who are outside the city of Casper paying the 6th cent. Is that happening? I think what I'm hearing is that's happening. And is that a situation? How does that get remedied, or how do we address that? Is that another situation where we bring that to your attention?
Mr. Chairman, Mr. Co-Chairman, yes, please bring it to my attention. The proper way in statute to go through the refund process is to actually reach out to that vendor. That's the first step is, hey, large online retailer, I'm not inside the city of Casper limits. You charged me a little more tax than you should have. Can you help me get that tax back? And that dialogue can be via email, can be via phone, however that happens. Then once that large online retailer refunds the tax back to the constituent, then they can come to the Department of Refund for the actual money there. What tends to happen though is sometimes getting in touch with some of the large online retailers is complicated. It's confusing. You don't know exactly where to go. That's where the Department of Revenue is willing to connect that bridge and make sure any of our constituents aren't charged tax in error. Yes, it is happening though, Mr. Chairman, and we're trying to mitigate that and reduce that as much as possible. We've also, real quick, my apologies, Mr. Chairman. I've also personally been inside the city of Casper limits and they're not charging the full 6% yet. So it does go both ways. And then since the vendor didn't charge it, that customer would technically have a sales or use tax obligation and send it in. Now, I've outlined many times, charging yourself use tax is, doesn't always happen, maybe as much as it should be. But yeah,
Senator
yeah,
Case.
but it does happen.
Mr. Chairman, with respect to the tribal situation, it's not really by location, it's by your affiliation and being an enrolled member of a tribe. And so that's extra challenging. We, just as a way of a potential solution, we have talked about moving to an arrangement where the tribal governments could actually assess the same level of sales tax that is assessed off the reservation, and then they'd be able to keep it, and it would eliminate the arbitrage. We definitely have talked about that. They're not really interested in doing that. Right now, if there is tax collected from Native people on the reservation through online companies, then the county gets a windfall of that tax. And so they get to keep it. So they're not real anxious to change this situation. But we have a very similar situation with cigarette taxes, which are, we have an archaic relationship about that from many years ago, an agreement of sharing. But if tribal governments wanted to impose a cigarette tax that was similar to Wyoming or a tobacco tax, they could keep that money and use it for any program they wanted. We have a lot of work to do there, and it's just wanted to mention it to the committee because someday we might get something done and it'll come through this committee. Thank you, sir.
Okay, let's move on to review of ATV vehicle sales tax collection. Say something. Co-Chairman Locke.
Thank you, Mr. Chairman. And Director, I know you know a lot about this topic. I don't know if the people who brought this to our attention are going to be able to attend today. I reached out to them and I don't know that they were able to. That being said, what we might do, and we'll see if they're able to attend. I don't know, do we have anybody online for this one? I thought that might be the case. I'm sorry. I thought at most on this one, we'll keep it fairly brief and maybe we'll explain it to the committee. I know the people would like to, if possible, move this to the third meeting if the time in the third meeting permits. And they would like to have maybe a conversation with the director in between just to make sure that we can present this reasonably. On the other hand, I think for this meeting, let's keep this. Again, I know you understand it at depth. It might be valuable for the committee to understand the problem because it is a kind of an interesting case. And so we'll use this maybe as informational and we won't get too hung up on diving too deep in it unless there's other comment. Thank you.
Go ahead, Director.
Mr. Chairman, thank you so much. Again, this is an interesting conversation, been going on for years, decades even. In the most simplest of terms, and so going to my memo, this is a memo, review of ATV and vehicle sales tax collection dated for today. So in the most simplest of terms, motor vehicles are sourced to where the owner lives and the sales tax is collected, sales and use tax is collected by our county treasurers. Okay, so really anything that gets titled, and I shouldn't even use that word, motor vehicles, county treasurers collect our sales and use tax on those. Okay, next point, ATVs. So in the most simplest of terms, again, these fall under a different definition and they are sourced to where the customer takes possession and the sales tax is collected by the vendor. Okay, motor vehicles, county treasurer, based on where you live. ATVs, well, actually, let me give you the exact, okay? Mopeds, motorcycles, and off-road recreational vehicles. If you buy one of those, The sales tax is collected where the customer takes possession, and it's collected by vendors. So here's the conversation maybe to have just briefly is, so I live in Cheyenne, Wyoming. I'm traveling up to the northeast corner of the state because there was just a big motorcycle rally in that area. I buy a motorcycle. The way the statute reads, that vendor is going to collect the sales tax from me, right? Maybe at a different rate, definitely for a different jurisdiction. But I live in Cheyenne, Wyoming, right? But now that county's tax, that county is getting that tax and the local entities that we distribute to. And so the question here is that the intention? There are definitely numerous resources, maybe not online right now or in the room, that have way more insight onto the why here with this. But going back in historical, motorcycles, mopeds, off-road recreational vehicles, mopeds, you didn't always have to go to the county treasurer for those. And in some cases, I don't know if you have to now either, right? Maybe there's an argument for motorcycles, but what about for dirt bikes? Right? And the intent of this conversation probably should not get into what's a dirt bike versus a motorcycle. That's into the weeds. But for this committee is just educational purposes, standard motor vehicles, where you live, county treasurers. And then the rest of these items, motorcycles, mopeds, off-road rec vehicles, the dealer or the vendor collects that tax. The tax is going to get to the same spot to the Department of Revenue. It's just you want it based on where you live or where you took possession of it. And with that, Mr. Chairman, I think we did pretty good, at least on that brief overview.
Thank you, Director. Co-Chairman Locke. Go ahead.
Thank you, Mr. Chairman. Director Fanning, you and I talked briefly this morning a little bit. There's a lot of states, I'll just differentiate a dirt bike. It doesn't have a headlight, for instance. We'll just use that, right? So you can't drive it on the highway. So for many states, they don't issue a title for those things. I don't know if that's still the same, but that's historically, that's when you don't get a title. Wyoming requires you get a title. So you have to demonstrate that you prove the sales tax. So in that instance, where you buy it, and I have bought multiple motorcycles in Colorado, the difference was that particular dealer was originally from Laramie, so he understood. He asked if we wanted to pay the tax there, which might have been less, right? I don't know. Or he says, you got to take it to Casper anyway, so you'll be paying the tax when you get your title, correct? So, so in that case, that the municipality is not getting the tax. Now, maybe if I did that today and bought another bike, maybe I would have to pay that sales tax for that particular municipality out of state. And let's say it's even more than what we pay. Now, I'm guessing when I come get the title, how would that work then? Now, they've already collected the tax, but it's not Wyoming's not getting any of that. So they would just say that they would just know that I have a receipt that I paid a tax somewhere on it and get the title.
Director.
Thank you, Mr. Chairman, Representative Brigatts. This is really an insightful question, and it doesn't get into the weeds. And part of it is why motorcycles were treated differently years ago. And it relates to all out-of-state sales as well. If you go down to Colorado and you purchase a motorcycle, generally, or any state, we shouldn't even circle out just one, any state, they're going to charge you their jurisdiction's sales tax. Okay? You've paid sales tax to another jurisdiction. I do it just as much as anyone else. When you go to your local county treasurer and you submit the paperwork to get the title and everything, there's a provision in our use tax statutes, and we're actually talking about that today. There's a provision in our use tax statutes that say if you've paid sales tax somewhere else and it's at least equal to the rate that you had to pay in your jurisdiction, you're good. You don't have to pay any additional tax. You don't have to pay Wyoming's tax on top of it, but you're good. But Mr. Chairman, Representative Riggins, goes to your point. We didn't get any of that tax. Because remember, it was paid in another jurisdiction. We don't collect other jurisdictions' taxes. So the answer is yes. For that motorcycle, you pay 10% sales tax in another jurisdiction. Your local community does not get any of that tax. Now, if you haven't paid sales tax, as was kind of referenced, then yes, when you go into your county treasurer, there would be an appropriate sales or use tax. They're not combined. It's just equal to your rate. That would need to be applied. Yes.
Representative Brown.
Thank you, Mr. Chairman. Director, you and I talked for a few minutes also this morning. I had a constituent call me and they had bought a vehicle. And I'm sorry, I don't remember the exact amount, so I just used my own figures for approximately $10,000. Went to the county clerk's office to pay the taxes on it, and they assessed it at $18,000. Now, I had a bill of sale saying $10,000. I know we talked about this yesterday, and you said $1,50,000. That's extreme. Could you touch on that and tell me what we can do about that?
Director.
Thank you, Mr. Chairman. Representative Brown, yes, absolutely. My example was extreme yesterday. But for the ones that are, and we kind of talked, you don't want to use the term reasonable, but 10 versus 18,000, if I want to get rid of that vehicle, I'm willing to take whatever I want for it. And if the seller is willing to sell it and it's an arm's length transaction, there's nothing like that. Generally, our county treasurers, in collaboration with the clerk's office, are going to accept that in good faith in the vast majority of the time. But there are provisions in our statute that say if there's a little something wonky there, and again, that's my word, not the statutory word, that there are some provisions in there to use a fair market value. There is fair market value in our sales tax statutes, and it does apply to some of these situations. But as was kind of mentioned, that's one I would love to look at that specific scenario. And I think I even said, even if you go to a county treasurer's office in error 2, you have avenues if you're charged tax in error. Now, the county treasurer refund process is a little different than when I said, go back to the large online retailer. If you have a county treasurer who you believe has charged you tax in error, I'll direct them to the form on our website to have our team look at it. I've got an administrator Ream has got an elite group of taxability experts. Well, they'll take a look at those documents, the title, the bill of sale, the chart, the sales tax that was charged by the county treasurer. They'll take a look at it and then they can file a refund claim. And then maybe we deny the refund claim or maybe we don't. If the Department of Revenue says, sorry, it was really 18,000 for fill in the blank reason, then there's also another avenue in statute where they can appeal essentially my decision to the Wyoming State Board of Equalization. So there are avenues. If your constituents are being charged tax in error, please reach out to the department. Please reach out to me. There are avenues in statute to make sure that no tax is charged in error. The Department of Revenue wants no more, no less than what's due.
Co-Chairman Locke.
Thank you, Mr. Chairman. And Director, another question related to these ATVs. This is truly as simple as certain vehicles are most likely titled or whatever, let's say, to be used anywhere, at least for sure. Some of these vehicles, you might buy it, put it on the ranch, and may not title it, right? That's really the issue. So this is truly as simple as certain vehicles may not get titled. I'm going to use it on the ranch and never title it. I don't care. And the others are, so I guess I'm trying to understand, if we make this distinction with these type of vehicles, this is a rule. These type of vehicles, this is the rule. The county treasurer, handles that. Where's the major issue with that's been raised to the revenue committee? Where's the major issue? What's the problem that we're solving here? I don't know that I'm quite seeing that clearly yet. Is this a situation where vendors for ATVs are confused on how to handle it? I guess I'm trying to understand what's the problem. I'm sorry, I wanted to make sure that if you'd make that clear, that'd be helpful.
Mr. Chairman, Mr. Co-Chairman, yes, absolutely. It's really more of a loaded question that goes back decades. The answer is, way back when, not everything had to get titled. There's been some statutory updates since then where a lot more things have to go through the county treasurer. And so the distinction, the kind of angst, based on my understanding of some really specific situations, is that should we have everything that's a motor vehicle go through the county treasurers? Should we? I don't know. Or should we have dealers be collecting our sales tax on these vehicles or certain types of vehicles? But I know that there are folks in the community on both sides of those coins. I know there's also a third kind of argument there is, if it's got a wheel or it's got to get titled or it's a motor vehicle, who does the legislature want collecting that sales tax? That's really the ultimate goal of this conversation, based on my understanding, is there are certain vehicles that go to one spot based on one sourcing, and then there are some vehicles that go to another spot based on certain sourcing. And does there need to be a distinction there? Once upon a time, it was that not everything had to go to the county treasurer. It just didn't. I purchased an ATV out of state, online, fill in the blank, and that didn't always have sales or use tax applied to it because there was no check there. But now there's more titling involved. I'm not saying it's going to get everything in this motor vehicle category, but who should be collecting the sales tax on motor vehicles? Should there be a certain segment that goes to county treasurers versus not? That's the kind of dialogue here, and that's the conversation.
Representative Campbell.
Thank you, Mr. Chairman. Thank you, Director. I'm just wondering, have you had the conversation with the treasurers in the counties to discuss what they thought would be easier to manage? Because it sounds to me like, it's a back and forth. I'm just wondering if we've had any action with the county treasurers to see what their opinion is on this.
Mr. Chairman, Representative Campbell, yes, we have. Over the years, even my predecessor, there have been numerous dialogues related to this exact question. But I'm not the one to solve it. I'm just one of the pieces. So if there are any county treasurers in the room, and I'm more than happy to reach out to them as well. Hopefully there are, but if there aren't, yes, we've had those conversations. And we've also had conversations with the motor vehicle dealers as well, and really in preparation for this meeting, because they also play an important role in this process too. Should they or should they not collect sales tax on motor vehicles? And I'm not saying either way, that's not my role. But yes, there have been conversations in the past on this. The main reason why the carve out for these particular ones was that going back years, there wasn't always confidence that sales or use tax was going to be applied to that class of vehicles.
Representative Locke.
Thank you, Mr. Chairman. And one other question, even today, and I know we just went through the exemptions yesterday, but there was a lot of stuff. Are some of these specific items, there are exemptions associated with some of these still for that? Is that true? And is that potentially one of the factors that creates this issue? Just curious.
Director.
Thank you, Mr. Chairman. Mr. Co-Chairman, the answer is yes. There are exemptions that do apply to these vehicles, and they apply to big rig vehicles. We've also mentioned agricultural vehicles. Those are also part of this discussion. Yes, having exemptions is just another piece of this puzzle that does provide confusion with the situation.
Oh,
And just for clarification, now I'm recalling the conversation a little bit better, I think, because I think that exemption and whether the vendors, I think that was one of the topics in here was whether the vendors, again, it's a kind of a good faith accepting this is not an exempt transaction. For example, I think that was at least one of the subjects in that conversation. So that complicates it slightly, but my recollection was that was a piece of this. Where that is potentially a complication, I say for the vendor selling, but I suppose it could be a complication no matter how you look at it. But thank you. I just wanted to bring that up. I'd forgotten about that.
okay. Well, thank you, Director. I think at this time I'll take a break till 10 after. All right, first thing I want to do now is over the topics, since they were all related this morning, open this up to public comment. Do we have any takers? Public comments. Sounds good. Did Brett get out of here? I don't think so. Did we lose the Brett? We are. And we're doing the electric generation tax options.
Yes, sir, Mr. Chairman. Yeah, so taxation of electricity generation, again, Mr. Chairman, Josh Anderson, LSO. So first of all, and it was noted yesterday towards the beginning of the meeting, of kind of what existing taxes we have on electricity generation. There's the tax on electricity generated from wind. That's found in 3922-101 through 111. And that was put into place in 2010. It's taxed at a rate of $1 per megawatt hour. There are some exemptions that are in place. Facilities that are owned by the federal government, state, city, or county are exempt from that tax. There's also exemptions for personal consumption by the producer, and that includes any excess production not exceeding 500 kilowatt hours in any 24-hour period. And then any new wind generation facilities are exempt for the first 3 years following the date the turbine first produces energy. And then the other tax we have in statute is on tax on electricity produced from nuclear reactors. That's in 3923-101 through 111. The tax in statute is at a rate of $5 per megawatt hour. That is sold. That was put into place in 2020. Again, there are the same exemptions for facilities owned by the federal government, state, city, or county. Also exemptions for personal consumption of the producer. Again, not to exceed 500 kilowatt hours in a 24-hour period. Then there's also what was just put into place was an exemption for an advanced nuclear reactor. And that's defined as any nuclear reactor that is an improvement over nuclear reactors placed into service before January 1, 2021. So it would appear that any nuclear reactor that was likely to be put into service in Wyoming after or going forward would likely fall within that exemption. There is a provision that beginning July 1 of 2035, the taxpayer would only qualify for that exemption if they purchase not less than, or as long as not less than 80% of the uranium used to produce electricity was sourced in the United States. So, Mr. Chairman, there's no other specific tax on other types of electrical generation, such as solar, coal, gas, or hydro. There are, of course, severance taxes on coal and natural gas, but those apply whether or not they're used for energy production in Wyoming or elsewhere. There have been some recent efforts to look into this issue. During the last interim 2024, there was an electricity taxation subcommittee It was housed within the Corporations Committee, but that included members of the Revenue Committee and the Minerals Committee. There are a couple documents in the materials that were prepared for that group. We had an issue brief that was prepared for that group, and then there's also a bill, and I'll toss it over to Dalton and Matt to talk about that issue brief, Mr. Chairman, unless there's questions right now.
Please continue.
Thank you, Mr. Chairman. Dalton Quilty, LSO. So the memorandum or issue brief I'll be presenting for you guys today is titled State Taxation of Electricity Generation. It was written in November of 2024 by a group of our associates. Neither Matt nor myself were on that authorship, so we're just going to kind of cover everything. I'm going to try and keep it brief and fairly high level. So if you guys do have any specific questions, please feel free to stop me. This issue brief provides background information and comparative assessments of state tax policies potentially impacting electric generation in the Western United States, electricity generation consumption and pricing metrics, Wyoming state revenue generated by various forms of electric generation, wind energy taxation in the Western United States, an initial estimate of state revenue generated through the imposition of excise tax on electricity generation as well. Now, this issue brief is looking at, we call it the Western Plus states. These include the traditional Western states of Arizona, California, Colorado, Idaho, Montana, Nevada, New Mexico, Oregon, Utah, Washington, and Wyoming, as well as some of our close neighbors, Nebraska, South Dakota, and North Dakota. Before we dive in particular, I have been told that one of the major takeaways the committee took from this last year was an effort to possibly shift electric taxation away from that per megawatt hour tax into a gross receipts tax. It would be a little more difficult for the Department of Revenue to administer, but our current megawatt hour tax does have unintended consequences to some extent of being a fixed cost regardless of your input costs or technological efficiencies achieved. Now, the national electrical generation distribution and consumption markets are different than many other commodities.
Quick question. If we switch the method of taxation, would we be collecting, in your mind, more or less taxes for the difficulty for the Department of Revenue?
Thank you, Mr. Chairman. It would entirely depend on what the tax structure was changed to, what rates you wanted to change them to. We could theoretically find something that very closely matches the current revenues that are being collected and use that, but I don't have an exact number. I don't believe they put an exact number on it.
Okay, thank you.
Beautiful. Thank you, Mr. Chairman. And as I was saying, the market for electrons is different than some of our traditional markets for gaseous liquids or solid combinations like natural gas and oil. Many different state tax structures are at play. You have wholesale and resale markets, regional disparities, different business plans, et cetera. So in an attempt to minimize the complexity where possible, this brief will focus on facts and known data. But it has incorporated some estimates where necessary, but all underlying assumptions used in those estimates are summarized in the narrative. This analysis excludes consideration of federal income taxes, federal tax credits, the federal retained portion of federal mineral revenues, and the abandoned mines reclamation fees and black lungs fees. This was chosen for two reasons. Wyoming policymakers have little to no impact on the establishment of these revenue policies. And while we benefit from these appropriations, the connection to the payments and services from the legislature is tenuous. So each state has independently developed their own tax structures, and as a result, there's very substantial variation reflected in both the basis of the taxes imposed and the types of taxes. Broadly speaking, though, overall, Wyoming tax rates are lower than the Western Plus states. Fewer taxes are imposed, although we do impose unique wind generation taxes. We are less favorably compared, both for the construction of generation facilities, especially wind generation, and the residential consumption of electricity. Wyoming has very favorable rates for traditional energy, but taxes wind generation and does not offer as many green energy credits or subsidies as many of the other states in the Western Plus. Now, Wyoming is a net exporter of power, meaning we produce more power than we use. About 46,000 gigawatt hours were produced, while about 17,000 gigawatt hours were used. And that makes us the largest exporter among that Western Plus group of states. Our retail cost of electricity is below the national average for residential, commercial, industrial, and transportation consumers. Wyoming electrical generators have a valuable commodity to export and sell to others. Now, the major takeaway from last year, as I previously said, was they wanted to consider a movement from a per megawatt tax and onto something like a gross receipts tax. This would allow for increased costs, inputs, or increased efficiency of production to be taxed accordingly. A bill was drafted in 2024, I believe, but it was not considered. Wyoming is the only state with a wind generation tax when you're looking at that full Western Plus. We impose the lowest combined total state and local sales and use taxes of states that impose a sales and use tax. However, if including all exemptions in the other states, Wyoming's combined sales and use tax rate is just above the median for all the Western states. We are one of 9 of the Western states that does not impose a gross receipts tax. And we have the second lowest effective statewide property tax on utilities and the third lowest after considering certain exemptions. We are one of 4 states not imposing a corporate income tax on companies generating electricity. Now, Table 1 shows in the memorandum, or the issue brief, excuse me, shows the future electrical generation plants in Wyoming and the United States as a whole. As you can see, a bulk of the plants under construction in Wyoming right now are wind generation. You do have a little bit of solar generation and very, very de minimis other generation, which could include nuclear, gas, geothermal. In terms of permitted plants, it's completely wind with 661 permitted wind plants, and plants pending application, there are 510 wind plants and 700, capacity plant of 510 megawatts and 700 megawatt capacity hydro plants being planned.
Representative Link.
Thank you, Mr. Chairman. My question is about this table. Is this the data as of 2024, or has this table been updated to reflect current projects?
Thank you, Mr. Chairman. This would have been the data as of November 2024. And that is for the entire memorandum, and it is as it was in November. Excellent. Thank you, Mr. Chairman. Stats from the Energy and Information Administration demonstrates overall U.S. power increased its generation by 2.6% from 2010 to 2022. The consumption of electricity across residential, commercial, industrial, and transportation decreased 3.6% over the same time. Generation for power increased in 9 Western Plus states, and it decreased in 5, including Wyoming. Wyoming is, as I said, the leading energy exporter for those Western Plus states, and state revenue from electricity generation comparison sorry, that was me reading a title. Getting into section 3, comparing our electricity generation from feedstock. This section is examining the amount of revenue various generation methods contribute to the state and local revenues. The methodology for this approach is detailed. For time, I'll kind of glean right into the meat and potatoes of the table. Table 2 shows total revenue per megawatt hour from wind, coal, and natural gas. Really, the big takeaway from this is natural gas provides the most, mostly because it's got several taxes that aren't included in coal or wind. But per megawatt hour, natural gas is getting $5.02, coal $3.08, and wind $2.29. Now, Wyoming tends to fall in the middle to upper range of levelized costs per megawatt hour on wind. When you include regional cost and capacity, Wyoming is one of 4 states that fall below the median. In the analysis, it's predominantly because of our higher capacity for wind generation. When regional factors are considered, Wyoming is second only to Montana for the lowest cost of wind generation. And this is all shown in table 3, the wind generation modeling, and it ranks all the Western Plus states in the order of their costs. And that is all I have planned to share with the committee. I can answer any questions if necessary.
Questions? Representative Campbell.
Thank you, Mr. Chairman, and thank you guys for being here. I'm wondering, when we're looking at this, do we ever do risk analysis to where our industries interact with other industries? Do we ever look at that? I'm just wondering, because I'm looking at how much revenue we're generating, but I'm also looking at some of these industries that are competing against other industries within our state. Do we ever look at how those interact with each other and offset each other? Thank you.
Thank you, Mr. Chairman. I do not believe that is covered in this memorandum. If it's something the committee is interested in, I can definitely do a little research and perhaps send a follow-up.
Thank you. Co-Chairman Locke.
Thank you, Mr. Chairman. And I'm sorry, can you walk through again in terms of one of the things, I don't think this memorandum necessarily goes into depth. Does it give us depth on where the bulk of our revenue is generated from power generation? Does it give us that? I know I've looked at the document, I haven't dove deep, but does it explain, state revenues, state, local revenues, all revenue related to coal, gas, wind, solar, just in terms, I guess I'm just curious in terms of revenue generated by each type, and is there a good table for that? And is that explained in here? I'm just kind of curious.
Thank you, Mr. Chairman. Representative Locke. In terms of this memorandum, I don't think there's a total looking at which is bringing in the most revenue. I do have some numbers on that in terms of the severance taxes that these different resources are bringing in. Oil is the breadwinner, as it were. But there's no numbers comparing the total revenue that each of these things is bringing in for the state, at least in this memorandum.
Follow-up?
Thank you. And kind of a follow-up to what you said before. So right now we have, in terms of just strictly power generation, we have a tax on wind at $1 per megawatt. Now that's exempted for the first 3 years, correct? And then we get that. And then for nuclear, it's $5. And and I'm sorry, I know when you mentioned this, but what's the exemption for that? Is there an X number of year exemption in advance of that, or what are the exemptions around that? And maybe more, and specifically, how does that tax and that exemption affect the nuclear plant currently being built? I think that's another point I'd be curious about as well. So sorry, I'm asking questions across these two different conversations, but that'd be helpful.
Sure thing, Mr. Chairman. So yeah, for the nuclear tax, the exemption is for any advanced nuclear reactor that is operated in accordance with statute. And the definition of an advanced nuclear reactor is a nuclear reactor that is an improvement over nuclear reactors placed in service before January 1 of 2021, and is also licensed by the U.S. Nuclear Regulatory Commission. So my assumption would be that the new reactor that would be built would fall within that exemption and as an advanced nuclear reactor, and so would not be subject to that tax. There is in 2035, that exemption only applies if at least 80% of the fuel, the uranium, is sourced from mines located in the United States. But so as of now, we're not generating any revenue from that nuclear tax that's on the books, only from the wind tax, Mr. Chairman.
Follow up?
Thank you, Mr. Chairman. Okay, so any reactor declared an advanced reactor, this nuclear tax doesn't apply to.
Correct, Mr. Chairman.
What's the definition of advanced?
So again, the definition, it's in, you can see it in 3511-2101. So advanced nuclear reactor means a nuclear reactor, including any necessary ancillary facilities or structures, that is an improvement over nuclear reactors placed in service before January 1, 2021, and has a license issued by the United States Nuclear Regulatory Commission.
Representative Riggins.
Thank you, Mr. Chairman. Thank you, gentlemen. Do you have a rough idea if, I'm looking at the chart for permitted, planned, projects. Do you have a rough idea for those are all on, private, combination, private state, or any federal operations or any federal, plans, to land them there?
Thank you, Chair. Thank you, Chairman, Representative Riggins. We don't have the specifics. We could look to update this. I would actually assume this has changed, a fair bit since last year, but I would assume that it's a mix of all of those state, local, federal, and private. So, I know the State Loan Investment or Board of Land Commissioners has looked at some on state lands, definitely some on private lands. So it would be a mix of all of those. We can look into trying to update at least this table, because I would assume that it's changed, since the last year.
Follow up?
Thank you, Mr. Chairman. I could go to the DEQ and permitting stuff and find all that stuff. I won't put that on you. It's not that difficult to find, so thank you.
Okay, thank you, Mr. Chairman.
Representative Lean.
Thank you, Mr. Chairman. Thank you, gentlemen, for presenting this. I do have one question about solar and wind. Are they also paying property taxes?
Mr. Chairman, yes, they do pay property taxes.
Follow up?
Follow up?
This may be for the director, but I'll give you a shot at it. Do you know how they're assessed, wind and solar?
I would have to defer on that, Mr. Chairman. Maybe Mr. Gio, if he's willing.
You might want to talk to the local assessors because they now assess wind turbines. Ms. Huxtable's here.
She's hiding her head. Follow up.
Mr. Chairman, Dixie Huxtable, Converse County Assessor, Representative Lean, yes, they are taxed currently. The equipment and plant is taxed. Typically, the land is leased, and so the land is not included in that value. But the equipment is taxed, and we do consider all approaches to value. Typically, initially, they are a cost approach because there's very limited income to look at. And of course, the market sales are probably non-existent in this area. So initially, it starts out with a cost approach. And then over time, as income becomes available, the income approach is reconciled into that value.
Follow up.
Ms. Huxtable, thank you for answering that question. My question is that for wind or solar or both?
Mr. Chairman, Representative, that's for both. I personally do not have any solar in my county yet, but I am confident that the assessor where it is located, that is the same. They're treated basically the same.
Senator Case.
I didn't mean to cut anybody off. I kind of accidentally left it on, but I could comment on the electricity tax study if you wish, Mr. Chairman.
Please.
Okay, Mr. Chairman, it was mentioned that last year we studied the issue of electricity tax situation. We produced some work products from that. This analysis was part of that study. We also had confidential legal advice from a law firm named Spillman, I'm drawing a blank. Do you remember the law firm? It was Robert Kontowitz. He's a Boston tax attorney, and he helped us to come to the conclusion that there aren't barriers to imposing taxes on electricity generation. We'd been told by the industry many, many times that we couldn't go down this road. He really helped to clear that analysis up, and that as long as we tax Wyoming residents the same as we tax out-of-state residents, or impose it on sales to in-state versus out-of-state, that was definitely would pass constitutional muster. Other conclusions were that we could develop a tax policy that gave credits for the other taxes paid by electricity generation. So I'm getting telephone calls here right next to me. So for example, some of our industries pay a lot of tax. For example, the coal industry and coal moving into electrical generation. You have property taxes on the plants. You have property tax on the minerals as it's mined. You have severance tax on the minerals. And so we work towards developing a policy where an electrical generator would receive upstream credit for those mineral taxes that were paid. So in essence, you'd recognize all the taxes paid by all the different forms of generation in Wyoming and allow them to deduct as a credit to their tax obligation from, say, a gross receipts tax on electricity. What this means is that coal plants probably wouldn't pay any additional tax. Natural gas plants wouldn't pay any additional tax, but they would be, it actually generate a credit for the utility or the other generator. We also looked at how we could keep Wyoming residents from being impacted by the tax. And that, that's very directly a constitutional issue. You can't say we're only going to tax electricity that's exported. But we have a unique situation in Wyoming in that we have a sales tax that we charge on electricity sold in Wyoming. And that's a tool. You could literally put in a gross receipts tax on electricity generation. Say you put in a 5% gross receipts tax. You could offset that by getting rid of the Wyoming sales tax or reducing it by a point or reducing it by 2 points, because the state could, we have a 4%. And you could, we actually looked at modeling how much revenue is collected at different levels of gross receipts tax. What would be the credits that companies would be able to take on their other taxes paid? One credit is like the wind tax. They pay $1 per megawatt, so that would be a credit in this assessment. Or we could just get rid of the wind tax. if it's going to be credited 1-for-1 against the gross receipt. But we could dial in and reduce the state sales tax so that Wyoming customers either pay very little more or don't pay anything more at all. It's quite a, you know, in a way, that's kind of the holy grail of taxation. There is an issue that we looked at actually taking the revenues and sharing the revenues back to local governments, which we mentioned the city of Cheyenne, how dependent they've become on sales taxes from electricity. The state gets a little bit of that, but you could literally reimburse in part or in whole local governments for the sales taxes that they lose if we were to reduce the sales tax. And that information would be available. You'd be able to calculate that because you actually know the sales. You'd have the taxpayers reporting these sales. So there were a lot of policy options that, you know, we finished the study up in December of last year. We did get a bill produced that it's not a perfect bill, that Representative Wiley carried as the main sponsor. I believe it was assigned to Minerals, I believe, but the Minerals Committee declined to take a look at it. And of course, it has to start in the House. I'm just saying all this because the conclusions were positive. There are lots of policy tools, and it would recognize, it would in essence be more technology neutral and recognize the changing mix of electrical generation in the world, which in, you know, last year that might have been different because there is a shift in federal policy with respect to energy, and I'm not sure how that's going to shake out in the long run, but it's perhaps a different landscape than we were looking at a couple of years ago. And I'd be happy to answer any questions. The legal memorandums are confidential, but the major conclusions are not. And we did brief the legislature at the start of the session last year.
Representative Campbell.
Thank you, Mr. Director, and thank you, Senator, for bringing that up. I really intrigued with that idea. I got a quick question. What would happen if Wyoming was to say to put an excise tax on outgoing electricity to where and then issued a rebate to the citizens of Wyoming to offset that? Would that be viable?
Mr. Chairman, I'm not sure I'm fully following the question.
Is there a way where we could charge the out-of-state customers a tax that we could issue a rebate for to the citizens that live inside of our state's borders? Would that be illegal, or is that approaching unconstitutional?
Mr. Chairman, it sounds like if it's a tax that's borne only by out-of-state customers, it would likely run afoul of the federal Constitution. And that's some of the stuff we looked at in the committee last year. And so I think the thought was if we had a tax that applied on all production, whether it was sold in or out of the state, that would be more likely to avoid those constitutional concerns.
May I tag on to that? Josh is absolutely correct. If we're going to impose any kind of a gross receipts or excise tax, it would have to be equally applicable to in-state and out-of-state customers. We would get in trouble if we tried to gather that tax up and then refund it to in-state people. That would be just too direct and obvious. But we have a tool in our toolbox, which is the state sales tax, which we can play with. We could reduce that, the sales tax on electricity, make it a different rate, drop it from 4% to 3% for the state. And for example, and that would pass muster because those are two different taxes with two different sources and really no connection. Did I do okay on that, Josh?
Representative Wharf.
Yeah, I guess I just, just thinking about this, I mean, this seems to me, I don't know why we can't do it. If Teton County can come up with the resort district tax that they're not paying, but others are, I don't see why we can't do that too. And I guess I'm being a little sarcastic, but I'm not. I think we should have the ability, it's something that we're exporting. And there should be the ability for the state to charge an export tax. You know, we have some states that have blocked our sale of coal. You know, and I really do. I think the state needs to look long and hard at this, because I do think there's an avenue that those people that are demanding, especially when they demand that taxes, or they demand the power be generated by renewables like solar and wind. Because there's no way to differentiate. Once it's put in the system, it's all electricity. But I do think we should be able to do this. And I think it's something, I know Senator Case, he's thrown this around, and I think it's something we need to pursue, because it only makes sense to me. If we can do that with lodging, why can't we do that with electricity that we're exporting? So I would encourage the committee to think long and hard about this. We should be able to come up with a way to do it.
And if the committee would like, in 2024, there was a bill put forward, House Bill 147. The proposed draft would have imposed an excise tax on the production of electricity, and then provided credits for other taxes like excise, sales, use, severance, and ad valorem taxes paid in that same tax year by the same taxpayer, or documented by other people in the case of severance taxes. The impact, or the estimated fiscal impact, included a total new tax liability of $133 million per year, and total tax credits were estimated at $115 million, meaning that difference of $18 million would have been distributed roughly equally between the state general fund and local government sources. So that's kind of what, speaking kind of to Senator Case's point, but that was the bill that they were looking at in 2024. If that gives you any sort of.
And Mr. Chairman, in your packet was also the 2025 version of that bill, which was House Bill 300. And it does a lot of the things that Senator Case described that were discussed by the subcommittee. So be happy to walk you through that if you would like, but it does a lot of what Senator Case described.
Representative Lean.
Thank you, Mr. Chairman. Thank you, Senator Case, for all of your wisdom on this topic. I'm not sure who wants to answer the question. I'm fumbling through all of the different ways that we tax in the state of Wyoming. And I'm just very clearly, is there one method of tax that the end rate user will pay that does not significantly increase my current constituents' bills? Because in Natrona County, our taxes our electrical bills have gone up almost 30%, and my constituents cannot take another hit on electrical tax.
Mr. Chairman,
Senator Case.
you know, a tax on electricity, unless you offset it somehow, it is going to impact Wyoming consumers. It may be worth it in some sense. Say we put a 5% additional tax on all electricity, and our customers in Wyoming pay it as well as people outside. It would raise an enormous amount of money right across the board for the state of Wyoming, which would give us tools to fund things in Wyoming that would benefit Wyoming citizens. But we do have this other way, that is the possibility of playing with the sales tax rate on electricity, which would, if we were to reduce that directly benefits Wyoming consumers, because they pay the electricity sales tax. And so conceivably, you could actually make it neutral. You could have a 5% grocery receipts tax that raises a whole bunch of money, but get rid of it on Wyoming customers at the sales tax level, so that it's a wash. There'd be a new tax of 5%, but you'd get rid of an old tax of 5%. The trouble with that works perfectly, except for one wrinkle, and that's the distribution of sales tax to local governments, which, as you've heard, some of them are very dependent on. So now do you take your pot of money that you gather and also reimburse local governments in whole or in part? That's a policy consideration. It would reduce the amount of net revenues that we would enjoy from the tax, but it would also not only keep our in-state residents whole for their bills, but it would also keep local governments whole with respect to potentially keep local residents whole or local governments whole with respect to the sales tax revenue they enjoy. It's complicated, and the payments back for sales tax revenues, they eat up a whole bunch of the main revenue you get. So it's probably going to be, the best policies will probably be in the middle, where we partially compensate, say 50% on the dollar for the lost sales tax revenue to local government, for example. Those all are policy considerations that work when you do the modeling. And a small increase in electricity for in-state residents, for example, really brings a lot of tax revenue in. It's a very powerful tax unless you spend it all offset with the other ways. But even if you do offset it the other ways, you net gain and set Wyoming up for a future when generation methods change over time.
Representative Lean.
Thank you, Mr. Chairman. A follow-up for you, Senator Case, would be, if we did it in that manner, would the data centers continue to pay that 5% tax, given the tariff situation? Was that ever explored, or is the tariff done after this study was done?
Mr. Chairman, data centers would pay their bills right now contain a sales tax on electricity. It's confusing with data centers because we've been talking about as sales, they don't pay sales tax on the equipment. They get that manufacturing exemption on the sales tax. But what we're talking about is their electric bills. So on their electric bills is the sales tax. Conceivably, we could take the sales tax off and add a new line right there that's the same size called a gross, it could be either by, it'd be best as a gross receipts tax on the utility, but it would be the same amount of money. So data centers would be a wash for what they pay. Distribution could be different unless we reimbursed local governments for the sales tax we no longer collect. And we could do that. It's complicated, but it works.
Representative Riggins.
Thank you, Mr. Chairman. And this might be a better question for Mr. Bush, who's lingering over there. I know it was asked something about differentiating, I can't say it. Well, the difference between the green and other sources of electrical energy and how they're combined, but they all end up still all end up in the grid. And I'm just going to presume, and Mr. Bush could confirm, if the cost of that production is different. So once it gets to the market, I kind of assume that Black Hills perhaps distributes that, or whoever's the transmission company, and how that's all divvied up. So isolating the wind turbine and solar panel generated power from the overall distribution is probably kind of difficult. So that would be the reason for just doing gross on it, because it's all going to be combined as soon as it gets to the substation. So any comment by Mr. Bush would be appreciated.
Mr. Chairman, David Bush, Black Hills Energy. Representative Riggins, if I understand the question correctly, once the power's on the grid, we don't know if they're green electrons, black electrons, whatever. I think that's probably accurate. I'm not the expert to speak on that, but I know people, so I can get you more information on that. It's generally credits that are renewable credits that are purchased by companies that are looking for the green energy and, you know, have a preference for that kind of, an energy. So, but I can get you more information on that for sure.
Senator Ide.
Thank you, Mr. Chairman. Yeah, quick question, with the conversation regarding gross receipts tax, which I assume we don't have any gross receipt tax on any industry. Can that be put on specifically to a certain entity or a business or industry? Thank you, Mr. Chair.
Mr. Chairman, I mean, it would depend on the specifics, but certainly it's just like any other tax that could be imposed in any manner. That's the way this bill was drafted, was to be a tax on the gross receipts or gross earnings from energy produced in the state.
Mr. Chairman,
Senator Case.
we do have two very important gross receipt taxes in Wyoming. We call them the mineral severance tax and the ad valorem tax on minerals.
Representative Ward.
Thank you, Mr. Chairman. Mr. Bush, I guess I have a question for you. You thought you could get away, but is it possible, even though we throw all the electricity onto one common distribution point, if you keep track of how much, and I'm assuming that that's how the businesses that you work with, you know how much electricity you generated, whether it was, you could tell how much your wind capacity generated, you could tell how much your solar farm generated, and you could tell how much natural gas or coal. Is that not possible for the industry to kind of map out how much electricity they're putting into that grid?
Mr. Chairman, Representative Worf, it is, and that all comes through the metering side of it. So it's just dependent upon, for us, we have wind farms, and I'm sure some of my colleagues can also discuss some of this. So the wind farm that we have right now outside of Cheyenne is contracted with particular users that wanted that energy. So we built it for them. It doesn't go on to everybody else's system. So at my house, I'm not using that power. So it's all metered, and yes, we can tell where our power is coming from, if it's coming from our coal plant, the gas plant, off the market, whatever. If it's coming from the market, that's where my understanding is we trust that the people that are marketing that power, whether it's coming from a wind farm in Nebraska or Colorado or Texas or wherever, those electrons are those electrons. So I'm not sure if I'm answering your question, but we can meter it all and figure out where it's all coming from. Yes.
Yeah, I believe you are, because that's what, it only makes sense to me. You know how much you generated. So I would think we should be able to tax wind. So if we got a state like the really big long one that's on the coast that seems to demand all this green energy, to me, that they've been putting so much pressure on our coal industry. To me, it seems like the state could tax that, and we could say wind generated electricity cost is taxed at this rate, solar's taxed at this rate, coal. I mean, we do all that because once it goes in the system, I don't know what the terminology is. Perhaps you can help us, Mr. Bush, but what do we call that? Because I mean, you called it electrons, but I mean, you're putting so much megahertz. I don't know how you talk about it, but whether it's coal, whether it's wind or solar, it's all going to be the same thing once it's put into that common system, correct?
Mr. Chairman, Representative Worf, correct. I mean, the electricity moving through the lines is the electricity moving through the lines, right? And again, I'm not an engineer, I'm a history major. So if anybody has more information behind me or up here, help me out. But it all comes on to the system, and it's just depending on where it's coming from, the generation point. So again, our coal facility in Campbell County, our gas plant east of Cheyenne. That's where we understand where it's coming from, is those different points. But once it gets on the lines, there isn't a wind power line right next to a gas power line. I mean, we don't differentiate it that way.
Yeah. So they're all using, my understanding, Mr. Chairman, is that they're all using, not all of them. You have some, like you have one wind farm that you mentioned that is built specifically for a specific purpose, and they are on their own line, on their own system. But we have a common system that's used by all these different sources of generation. And that's the line to me. It only makes sense. We should be able to tax that. They know how much wind electricity went into that common line, how much solar, how much coal. So I really don't see why we can't tax these at different rates and just say, you know, those that want to use the common line, but they want to demand that it's green energy, I think the state has every bit the ability to tax that. And whether it's being used by people in the state of Wyoming that want green energy, I don't care. But I think if that's going to be the demand, we should be able to tax that based on the costs to the state, based on an equal footing, because that's to me the thing that I think is a little unfair. In my mind, we have different tax rates, and like solar right now, we don't tax at all. Wind isn't taxed until it's been 3 years in production. So, and I appreciate you, Mr. Bush, answering that, because I didn't want to put you on the spot, but I did. It was kind of fun. I appreciate that, but I do think, Mr. Chairman, that's something that the committee should look at, is the ability to maybe LSO can draft this legislation where we tax everything equally. Whether it's green energy or whether it's, you know, good old reliable coal. I mean, I think we need to be promoting the things that benefit the state. And I really don't care if somebody wants to have wind generated in our state, they should be paying for that. Those that want to have cheaper rates should be able to go with the cheaper production costs of coal and natural gas. So I don't know if the committee has any desire to do that. I mean, I would suggest that we have LSO draft something like that.
Co-Chairman Locke.
Thank you, Mr. Chairman. And I'm sorry, I might be a little off topic there, but I want to go back to kind of your original report too, because one of the things I wanted to understand, and there's lots of numbers strung through this report that you just went through. And for me, I've got to see this in numbers in some format I can understand. And so I guess, and this data I know is out there, and okay, bad on me for not having looked at it or seen it. But I'd like to understand from LSO, the department, whoever's the right people, a couple different things. I'd like to understand the breakdown, and it's out there, I know, and but I'd like to understand the breakdown of the power that is generated. You talk about the 46,000 gigawatts of power that we generate. I'd like to understand how that breaks down for all of the different sources of electrical energy. Okay, I think we need to understand, we need to see how that breaks down. What's generated by coal, what's generated by gas, what's generated by wind. I think we need to understand how that all breaks down. At least I feel like I need to. The second thing is, and you've got bits and pieces on this in this report where you talk about which one of our generation methods generates the most revenue for the state. You've got that in a megawatt per hour, but I think I'd like to see that in a table that shows how, I'd like to see that in a table that shows how well gas produces this much revenue. And again, I know all those numbers are out there, but I'm trying to get this into a single picture we can look at related to electrical generation, so we can really see this picture, because you can pull these numbers from all kinds of different places, but I think you've got to see all of these together. And these are some requests I'm making, because it's very hard to look at this and then I think once we can see that picture clearly, it's a little easier for us, and I don't want to speak for all of the committee here, but it's a little easier for us to start to say, okay, these are the people that are paying, these that are helping people, and these are people that are not paying. And then the other part of this, and just a comment that I make to the committee, and that I'm trying to get my head around, and I don't have a good question or ask of LSO on this one, is for every dollar of per megawatt of power production, and I think the senator has given a lot of good data there, but for every dollar per megawatt of production we add, there's an impact. And so maybe these numbers help us to see that, but that's going to be an impact on our ratepayers. And then we're going to have to understand all of those numbers to actually then look at that number that, for example, Senator Case's, that concept that I think is out there, which was some great research. We've got to understand these numbers well enough to be able to say, okay, we can put this number on wind and solar and then manage the impact to our people in this way, our ratepayers in this way. That's a piece I just cannot picture with all of these little different, $5.02 per megawatt for natural gas. We need to see some of those bigger picture numbers, because it's too hard for us to understand the impact that we're having when we're making these rate change decisions. That's one man's opinion, but I think those are some things I'd like to ask for from the LSO and from the department on how do we come up with all of those different pieces of data. I'm throwing that out, and I'd love to hear, again, if you just can point me to, hey, I'll point you to 2 documents that'll tell you that, that'd be fantastic. Thank you.
Thank you, Mr. Chairman. Yeah, we can work on reworking some additional information that has bigger picture and implement some of this and get back to you.
Representative Lean.
Thank you, Mr. Chairman. In the updating of those reports on the top of page 3, where it talks about how much energy Wyoming is consuming versus exporting, could we please update that number? Because I'm aware that there's some data centers that have come online. And so so that the committee has a clear understanding of what's happening in Wyoming there. And then is it possible for LSO to forward the confidential documents that Senator Case is talking about to the committee only, knowing that those are confidential?
Representative Campbell.
Thank you, Mr. Chairman. Thank you, guys. I want to go back into what I was saying about risk analysis. And the reason why I'm bringing that up is there are certain portions of the energy sector that are in direct conflict with tourism. Tourism is our second biggest revenue generator. So my concern and where I want to look at is if we make an advance in energy, but that advance in energy is offset by a decline in tourism or vice versa, there is definitely a fiscal impact on that. So we need to be aware of how we proceed with our energy section, how it interacts with our other industries. Tourism, I know, is our number 2 right behind energy. So I don't want to see those in conflict. It doesn't do any good if we gain 10 in one and lose 11 in another. Thank you.
Thank you, Mr. Chairman. That should be doable. My only level of concern with some of those numbers would be tourism is kind of locale based. And you're also, when you're mining a mineral, you have to be on the coal deposit to do that. And that coal deposit may not be in a location that is popular for tourism. So I don't know necessarily how correlated those impacts would be, but I can bring forward some numbers to the committee on that.
Okay, thank you, gentlemen.
Mr. Chairman, one more thing. The Wyoming Liberty Group, and I used to be on the board of the Wyoming Liberty Group. quite a few years ago, and I'm not associated anymore, but they did produce a recent report on electricity taxation. You might take a look at that. It's on their website, or I shared you guys a PDF copy. I'm happy to help with further work on this. This has been close to my heart for a long time. I think what you're also going to hear is that people will be arguing that Wyoming doesn't produce as much electricity as they used to, and that as we used to, and that the situation is changing and we're not that competitive. Well, the truth is we don't produce our coal. The coal plants aren't running that much anymore. Maybe that's going to change in the future, but that's the source of the decline in exports. So we're not exporting quite as much as we used to be, but it's solely related of the basis of the changing technology. Wind does not make up the difference that the coal had provided. So times are changing. Thank you, Mr. Chairman.
Thank you. Open this up to any of the agencies that want to speak on it. Any public comment?
Hey, good morning. My name is Kara Choquette. I work for two companies, Power Company of Wyoming, which is constructing and developing what would be the largest wind power plant in Wyoming, as well as a very large natural gas generation facility, as well as Transwest Express, which is developing a large export transmission line to connect Wyoming to new markets it's not serving today. Both of these companies are parts of the Anschutz Corporation, which you probably know best for oil and gas exploration in the Powder River Basin. One of the largest mineral taxpayers in Wyoming. Through these businesses, we hope to be one of the largest non-mineral taxpayers in Wyoming. I've been working on these issues since 2009, and I took notes on a bunch of questions that the committee had, but I may not remember to address all of them. So if you have any questions for me as we go along, please let me know. I just thought I would go through, Mr. Chairman, kind of my prepared remarks first, which is addressing, first of all, the LSO study that was referenced and provided in the meeting materials. Thank you very much for that. In short, we don't see anything in that report, which was very well done overall, that says that there's a need for Wyoming electricity to be more expensive. If the state wants to minimize its tax burden on its citizens and businesses, these electricity products have to stay competitive. And there's a whole lot of reasons for that. As you all know, it's very complex. Secondly, the LSO analysis in that wonderful chart on page 7 talks about some, I think, good news for this committee, and that the state tax the state tax playing field is already level between our top two sources of electricity that's produced in Wyoming, and that's coal and wind. Representative Locke, I have the numbers from 2023, but at the time, 46 million megawatt hours of electricity that were produced, about 33.5 million came from coal and 9.7 came from wind. Following that was natural gas at 1.6 and hydro at 744. So you can see very clearly in the data, coal and wind are the top source of electricity. According to that analysis from the LSO, if you look just at the state tax burden, which is what I think we in Wyoming are concerned about, is what can the state do and compare those equally. Wyoming wind power plants pay $2.29 per megawatt hour in state tax burden to Wyoming, and coal generated electricity paid $2.33 per megawatt hour in state tax burden in Wyoming. That's essentially equal. I will note that, as I think was already discussed, this report was prepared in 2024. So that was when coal was at a severance tax rate of 6.5%, and that has subsequently been reduced to 6%. Finally, and I think some of this discussion has already happened today, and I appreciate that, is I think there's not a lot of visibility because of the way that it's reported or not reported in, say, the Department of Revenue annual reports, which has a lot of great information, but it doesn't really clearly highlight how much property taxes and sales and use taxes are paid by the power generation industry. So I went through the wonderful reports provided on the Department of Revenue website, looking at minor business classes by state and by county, and I'm happy to give you copies of this as well as the LSO. All power generation and supply is considered NAICS Code 2211 properties. And in fiscal year 2024 and 2025, NAICS Code 2211, power generation and supply, was the 6th largest source of sales and use tax revenue for all of Wyoming. And that's just that NAICS code. If you think about a project like ours that's been under construction, we have people in town that are renting, people in town that are eating, people in town that are dining, shopping, buying fuel. We also pay sales taxes on leases of heavy equipment. A lot of our heavy equipment is leased from Wyoming Machinery with their wonderful facilities here in Casper and in Rock Springs. All of that generates sales tax that contributes to other of these top 15 categories. As we discussed, travel accommodation is certainly one of the top sales tax categories as well. If you do the same analysis looking at property taxes and specifically industrial non-mineral property taxes, and that's where I think it's really important to try to distinguish between Wyoming's mineral taxpayers, which I think Representative Locke or Chairman Locke, to your question, no question, they're the biggest taxpayer in Wyoming, will always be. It's an amazing amount of revenue that the state is lucky to get from coal, oil, and gas. But in the non-mineral sector is where power plants are compared. And in the non-mineral sector, if you look at, again, all state assessed and county assessed properties in the non-mineral sector, just the category of major electrics is the 3rd largest such taxpayer in the whole state of Wyoming. And that's just one of the 4 categories in NAICS Code 2211. If you combine all of the NAICS Code 2211 properties, so it's major electrics, rural electrics, power generation, wholesale IPPs like we are, or municipal electrics, that total assessed valuation is over $750 million. That's the 2nd largest class of non-mineral taxpayer for the entire state of Wyoming. So I wanted to share that new information. I try to bring new information to the Revenue Committee every time we have the opportunity to talk about this project, because I don't think anyone has really clearly kind of looked at the significance and the importance of the property taxes. So when you look at the power generation sector, what's the most important thing for Wyoming is that non-mineral property tax base. That is what I call the cake. That is what funds our local governments, that funds our schools, helps reduce the burden of the mineral industry because they do pay so much of the severance taxes and other taxes as we've discussed. The second slice of cake is that sales and use tax revenue. That is a huge amount of new money. The renewable energy industry, both wind and solar, that sales tax exemption went away in legislation that was passed in 2009. So there's no sales and use tax exemption. We also don't qualify for the manufacturing tax exemption. I think there was some discussion that was maybe something that this industry could qualify for, and we do not. The third then, the frosting on the cake, is really that electricity generation tax. And as you've heard, that is unique. It is unusual in the West. That is something, though, that, as you can see in the LSO analysis, is what assures wind and coal already pay the same per megawatt hour in taxes. Again, I'm happy to share this information with you. And if I could just take a moment to address, I think, some of the other questions that were brought up. Again, there is data about how much electricity is available and produced by each source in Wyoming. As has been discussed, the amount of electricity that is produced in Wyoming is declining. The amount of electricity that is exported from Wyoming is also declining. At one point, it was about 71% of Wyoming's electricity supply. Now it's 55.6%. When you look at that 14-state region that was discussed, kind of the WEC region and the extra states, and the extra states are included because Wyoming exports power east and west. The Laramie River Station is a great example, and it's a really cool power plant. It's one of the only ones that I'm aware of where 1 unit of all of that power goes east and 2 units of that power goes west. So we export power all around Wyoming to those neighboring states. I think there was a question too about federal land and the amount of wind and solar on federal land. There isn't a lot. Nationwide, only about 1% of wind energy is installed on federal land. Our project, the Chokecherry and Sierra Madre Wind Energy Project, is proposed on a checkerboard or under construction on a checkerboard of federal land. So we estimate about 1,775 megawatts of that project would be on federal land. All of that is taxable. So if you have a wind turbine on federal land, you're paying federal royalties, federal fees. I also have good news for this committee in that regard. When we first started talking about Electricity generation taxes again in 2016. We presented before the Revenue Committee and said, instead of adding taxes that increases the risk that our project can be successful in Wyoming, let's work together and try to get a greater share of the federal revenues and fees that we already pay to come back to Wyoming. We've been advocating for federal revenue sharing for renewables since 2016. In 2017, we worked with this committee to draft a resolution that was passed by the Wyoming legislature and signed by the governor that called on Congress to provide for federal revenue sharing. And thanks to the One Big Beautiful Bill Act, we now have federal revenue sharing in effect for wind and solar on federal land in Wyoming. That is exceptional news for this state. Even if it's just our project that ends up being on federal land, the way that that federal revenue sharing provision evolved over the years is 25% of the federal fees and royalties that we pay will now come back to Carbon County. That is a huge additional slice of revenue for Carbon County. And then another 25% will come back to the state of Wyoming. I presume that will go into the general fund. So again, that wasn't available at the time of the LSO analysis. You see in that chart on table 2 that there is credit given for the federal fees and royalties that are paid by coal and gas that come back 50% to the state. Well, we're going to have that too. And it's very exciting to be able to tell this committee, after first discussing it with this committee in 2016, that federal revenue sharing is now finally in place. So with that, I'm happy to take any additional questions. I also did review the Liberty Group report that was referenced and have comments on that if that's of interest to the committee.
Senator Ide.
Yeah, thank you, Mr. Chairman, and thanks for your testimony. If you would provide us with the federal mineral royalty that is coming from wind that's in the Big Beautiful Bill, if you could provide this committee with any details on that, that would be wonderful. Thank you, Mr. Chairman.
I sure can. Thank you, Mr. Chairman. The revenue sharing, basically, again, is 25% to the county, 25% to the state. The federal government retains the rest that goes to the U.S. Treasury, and that change happens in 2026.
Representative Lean.
Thank you, Mr. Chairman. Thank you for coming today and presenting for us. I'd be interested in your handouts if you have them for the committee. My question for you is, yesterday we heard about different industries that the committee is not able to identify particular companies that are receiving tax breaks. So my question for you is, as a wind industry, is there anything identifiable in your property taxes per company, or is that all lumped together?
Mr. Chairman?
Please.
Yeah, if I'm, thank you for the question, Representative Lean. If I'm understanding your question properly, there's no sales and use tax exemptions for this industry, and there's not any difference in how properties are assessed. They're just an industrial non-mineral taxpayer like others, assessed at the 11.5% assessment ratio. So as was discussed earlier, wind power projects that are wholesale or independent power producers that sell their wind or their power on contract, those are all assessed by the counties. A wind power project or solar project owned by a rate-regulated utility in Wyoming, those are all assessed by the state as part of that overall bundle of power plants and generation and distribution that they own. So they're assessed the same way. The assessors follow the same practices, have the same guidance, go through the same training, but there is a different referee, if you will, or judge that looks at the county assessed wind farms are different than the state assessed wind farms in that process. But in my handout, I did try to combine those so you can kind of see the total picture of what contributions are made by NAICS Code 2211 properties.
Follow up.
Thank you, Mr. Chairman. Thank you for that. It sounds like you've been in the industry for some time. And so my question is, have you always been state assessed or county assessed? Because alluded to a comment earlier from the good senator, it sounds like we recently gave this authority to the county assessors to assess wind turbines. Is that correct?
Mr. Chairman?
Please.
Yes, Representative Lean, thank you for the question. Yes, I have been working in this industry since 2009, when all that wind farms paid was property taxes. Then the sales and use tax exemption went away, which increased our taxes, as well as the addition of the dollar. Until, and forgive me, I don't know the years, it was a couple sessions ago,
We got one more.
all NAICS code 2211 properties, so all power generation transmission was assessed by the state. The state assessors have specific experts, you know, different industry categories. The previous director of the Department of Revenue felt that there was a statutory clarification needed to make sure that that practice could continue. And that statutory clarification did not pass the legislature. So as a result, recently, wind and independent power, which does include some natural gas in Wyoming, but wholesale power producers are now assessed by individual counties. And how they have done that is a relatively new thing. Hopefully I'm summarizing a very complex topic in a short way as possible.
Representative Riggins.
Thank you, Mr. Chairman. Thank you, Karen. How long does the federal subsidy be applied to a new facility, or how many years does it last? Start with that question. Thanks.
Mr. Chairman, Representative Riggins, that's a great question and one that we've talked about a lot at this committee over the years. If you get the federal production tax credit, it is pre-sunsetted. It only lasts for 10 years. You have to be producing electricity to get it. So we have to spend all the money, time, effort to get the plant up and running before you actually qualify for anything. All of this development to date is done with our own private capital, the Anschutz Corporation. I think there was a question yesterday too about not operating wind projects. The legislature in 2010 or 2011, I forget, I didn't bring all my notes on that, but really looked at holistically, how are wind power projects taxed and regulated in Wyoming? And as a result of that, came up with a lot of new rules, different standards, expanded public notice, more authority given to the Wyoming Industrial Siting Council. And one of the things was newly permitted projects. If you haven't been operating in 2 years, you have to go through the reclamation and decommissioning process. And there's also reclamation and decommissioning bonds that have to be posted up front before you even start construction. So, and there's no self-bonding or blanket bonding. So for example, our project, we thought it would cost, you have to do a whole reclamation decommissioning plan. You present that to the Industrial Siting Council. We do the same for the BLM, the portions of the project on BLM land. And they look at that every 5 years. And if your estimated costs have gone up, you have to bond accordingly. So we're paying over $1 million a year in premiums to hold bonds for over $265 million of bonds for reclamation and decommissioning of our project before it's even built.
Representative
Chairman.
Riggins.
So I guess my long-term concern is when they quit appropriating, that's per megawatt hour. And it's a probably, if you took a market price of it, $60, it's a third of it or better, 27.50 per megawatt hour. Does that sound correct?
Roughly, it is adjusted with
Yeah.
inflation. I'm sorry.
So I mean, I'm just thinking if that's going to go on perpetuity or until they tire of it, and what happens after that to this industry. I mean, I know it's critical for this initial construction and development and all that. So I'm just wondering what happens if out of the blue in 4 or 5 years, they decided that's costing them too much money and they want to go a different direction. Is the industry prepared for that? Or let's say they cut it in half or a third or something like that.
Mr. Chairman, Representative Riggins, I think when you get into those questions of federal tax policy, it definitely gets pretty complicated. The issue I would suggest you keep in mind here is that whatever happens, it affects all wind and power plants in every state equally. So we're on a level playing field with other wind and solar that we're trying to compete against. I would say, you know, looking to the very kind of site-specific nature of Wyoming, one of the challenges is the distance from the markets. If you want to continue to export power and reach new markets, as we're trying to do with Transwest, new doesn't compete with Powder River Basin coal. These are new markets that aren't buying Wyoming coal. They aren't going to, let's try to sell them something they will buy, in our view, electricity. It's going to cost more to get it there. We have to charge more for the power. It's going to cost more to get there. And that's why, as one of hopefully the biggest power producers in Wyoming, we're so concerned about the costs and economic viability in Wyoming because we have to account for delivery 720 miles to a market. Or if we have the opportunity to bring new load to Wyoming, we have to keep our power price competitive enough that we can help bring that new load, those new large customers here. It's so dependent on price. And that has been our overriding concern since 2016. Again, we have had 2 tax increases in Wyoming since we started. We're continuing construction. I just try to make the committees over the years aware of increased costs, increased risks to us, which increase risks to your constituents, and that if our projects doesn't happen, I did a recent analysis too of actual revenue for Carbon County. Just the electricity tax paid by existing wind projects in Carbon County paid $1.55 million. That's the 4th largest source of revenue to Carbon County's budget this year. That got another roughly $1.5 million, just the 12 mills that goes to the county. So that county, if it wasn't for the power generation sector and wind, would be $3 million short on a $21 million budget. And who would make up the shortfall is those constituents, or you go without services.
Representative Lean.
Thank you, Mr. Chairman. I hear you say that we need to stay competitive in the market. Can you give me some examples of what the utility cost is, say, in another location of which your company presides? Is that Utah, Colorado, Idaho, somewhere in the nature?
Mr. Chairman, Representative Lane, that is a great question. So our business as a wholesale power provider, we are uniquely focused on this power project, which is on a ranch that the Anschutz Corporation owns. We don't have any other power generation. So we say we have one wind project and this natural gas project we're working on as well, but it's just in Wyoming. So it either happens here or it doesn't happen at all. Where you see the competition is in prices. Or the University of Wyoming in 2016 did a study, which, forgive me, I don't have it in front of me, but looking at what is the totality of taxes in all these different states. Wind farms in Colorado pay an average of $1.57 in all totality of the taxes. At the time, wind in Wyoming paid $3.05. It's looking at the costs to do business and those totality of the taxes. Wyoming might have a low sales tax, but it's still greater than Montana, which has no sales tax. Idaho might have a gross receipts tax, but it's in lieu of something else. And I think as was alluded to in the good presentation is every state kind of looks at what are their site-specific considerations and the site-specific markets. For the wholesale business, you know, when you have a rate regulated utility, you're going to the PSC and saying, hey, I want to build this thing and I need permission. And then they say yes or no, and then they recover that in the rates. It's not the same for us as a wholesale power provider. We have to compete into an RFP. Those utilities are extremely vigilant in wanting to make sure they're only contracting for the lowest, best price possible. And sometimes those contracts are decided by pennies. It's like, name that tune. I can deliver you power for $30. I can deliver you power for $29.98. It's that competitive in those spaces. So our particular project, we do not have a customer. That makes us unusual in a number of ways. All of this has been done at the development risk of the Anschutz Corporation. All of the roads that are being built, the turbine pads are being constructed, all of that is at our own cost right now. But we're working toward getting that. But we believe in it, and it's what we're doing is really hard. Creating a whole new market for Wyoming electricity where there's not a path today is a heck of a lot harder than building a new power plant in the existing service territory. You're just selling a different thing to the same service territory. We're trying to create a whole new product and a whole new area of market opportunity for Wyoming. It's a lot harder.
Follow-up?
Follow-up.
Thank you, Mr. Chairman. Talking about funding for the transmission line, my question is, are you receiving any government dollars for that from the WBA, the Wyoming Energy Authority, the Wyoming Business Council, any of our entities? Is there any kind of supplemental dollars coming to you for the construction costs of the transmission line?
Chairman, Representative Lean, we've asked for nothing from the state of Wyoming, have received nothing.
Representative Campbell.
My concern with this project, well, pretty much all projects anymore, it doesn't matter if they're wind, fossil fuel, whatever you want to call it, is politics does affect a lot of things. Since you guys have lost the 45Y and the 45E credits, And you just told us that most power companies recover their loss, their cost and rates, and you guys don't have the ability to do that. Because you guys are so heavily subsidized, what is your long-term viability in the political environment that we're in? Thank you.
Chairman McEwen, Representative Campbell, that's a great question. I think everyone is struggling with right now is there is so much uncertainty. So I can say our project is fully permitted. We have long been under construction and we are continuing construction right now.
Oh,
Thank you, Mr. Chairman, and thank you, Kara. That is where my concern is you're fully funded and everything now, but you're getting ready to open, as you just said, you're getting ready to enter an open competition for power. What is your long-term plans for viability to compete? Coal, as Senator Case has indicated, has declined a bunch under the past administration. Coal has the opportunity perhaps to rebound sharply under the current administration. Much as coal was curtailed under the past administration, what is your plan moving forward to ensure success under this administration? Thank you.
Mr. Chairman, Representative Campbell, we are watching every action, evaluating those actions that come out, seeing how our project stacks up, looking where we can minimize risks. But from the beginning, we've been very honest with this committee to say whether our project will be fully built depends on project economics. And that has to consider things like state policy, federal policy, costs. There's a lot of uncertainty right now about what are the costs of wind turbines, what are the costs of transformers. And again, what's really hard is, and you've heard a little bit about this earlier, Wyoming made last year 43 million megawatt hours electricity. Only 17 million was sold in state. It's very dependent on external markets. We have to compete in those external markets who have their own choices in power. So I'm from Nebraska originally. I grew up on a farm. In Nebraska, you hear in local things, hey, let's stop sending our money to buy Wyoming coal. We're going to put up a wind farm here. It's other states around Wyoming that's more of the issue. You can build plants in other places, power plants. So new technologies have provided for new market choices. You look at those EIA maps, there's a lot more power plants around Wyoming than in it. 5% of all the power made in this 14-state region comes from Wyoming. We're trying to grow that, make that more. Bring those property taxes, bring those sales and use taxes, bring the electrical generation tax that we have right now.
follow-up?
Thank you, Mr. Chair, and thank you, Kara. Again, I fall back on viability because I fear that you guys are going into the open market and that's the way the market goes, is it goes to the cheapest that it can get when it comes to electricity. And I thank you very kindly for explaining. I understand that consumer drives the market, and there are some states that are very specifically wanting green type of energy. But as the market conditions change, I just want to make sure that you guys have got the capital to be viable long-term to sit this out, because I think that the political environment's going to go back and forth. And this is a market that's existing now and expanding. I'm just not sure how you're going to be able to compete in an open market that is wide open. And if you guys have planned for that to where you have the capital to sit out the storm, so to speak.
Mr. Chair, I guess I would just repeat my comment that we are continuing construction and watching everything very carefully. And again, I don't come from Denver to appear on very many topics at the legislature. I come for this topic to show you how important it is. I come as an employee of the Anschutz Corporation to tell you how important this is. Economic risk is the biggest risk our business has to face. We have such tremendous support in Carbon County for our project, including from the Carbon County Visitor Council. They realize that where our project is very compatible with the overall tourism and overall energy plans of the county. They realize the jobs and how important they are, the corporate sponsorships of things that we can do in the community. So we're doing everything, what I say in Carbon County, we are doing everything we can to make this project a success in and for Wyoming, but we know we can't control everything.
Representative Lean.
Thank you, Mr. Chairman. My question is actually for LSO. Thank you for your comments. In the Madden formula, is there a way to identify when a county is no longer a hardship county? I'm hearing the economic benefits very locally of these wind farms. And so I'm curious, knowing that there's some of these projects on the table in some of our hardship counties, do we have some kind of trigger in the Madden formula that then kicks out a hardship county?
No. So the Madden formula is it's very complicated. So I'm trying to best phrase it in my head. It's gonna look at the state holistically, and it's gonna try and make everybody complete. So if a community was getting a lot of money from, say, a wind generation site, they might not have been in a hardship position because they were collecting sales and use revenues or whatnot from that wind generation. If that construction completed or for whatever reason closed down, there is a potential that that community could fall into the lowest percentile and be marked as a hardship county. But because we're looking at the entire state, it's kind of relative. If the entire state is suffering from something, everybody would move down probably the exact same rankings. If one area in particular is suffering, that's when the Madden formula is going to come in and try and make them whole.
Mr. Chairman, just if I could maybe hopefully help address your question. Our project, because of the involvement of Checkerboard BLM Land, went through a full environmental impact statement. The BLM estimated that our project would be the largest property taxpayer in Carbon County by a considerable margin, and suggested that we would make Carbon County a recapture county because of the revenues. If there's no other questions, I just wanted to offer my willingness to be a resource. I know there's a lot of questions about wind, how it's taxed, wildlife, eagles. I'm ready and able and willing to answer all those questions. This just might not be the right venue for it. So feel free to reach out.
Thank you. Co-Chairman Locke.
Thank you, Mr. Chairman. I know that Mr. Ryman here is probably here to answer the question, question coming up. But after that, if I'd ask you not to leave, I know you had talked about hitting that other report.
Oh, sure.
If we could just, I think it'd be good to summarize, Senator Case mentioned, I think that report probably, and there being good data, there might be some additional data for the committee. And so if you don't mind, I know we're probably going to bounce
Me and
back and forth,
him,
but
or him and then me.
I think he's going to answer a recent question, but I just didn't want to skip over. I know you were going to hit some data that might be valuable, and I know I'm asking for more data. So thank you.
Commissioner.
Mr. Chairman, members of the committee, Jeremiah Rima here on behalf of the Wyoming County Commissioners Association. The only reason I got up was to help LSO out in answering the question about hardship counties. So in the Madden formula, the threshold is a county's ability to generate $300,000 per mill. So if a county is not able to generate $300,000 per mill, it is categorized, there's no such term as hardship actually in the formula, but we generally consider them hardship counties. There are counties that come in and out. Crook County is one of those that was recently out, is back into hardship status based on property tax changes. So there's roughly between 6 and 8 counties that fall into that category. I don't have them specifically in front of me, but I can get those to you.
Go ahead.
All right. Well, thank you. Thank you for the question. This is just my thoughts on the report that was mentioned, produced by the Wyoming Liberty Group, consultants working for them, balancing the scales, how Wyoming can protect its energy revenues. My colleagues are mineral tax experts. I am not, so perhaps the mineral aspects of the report are accurate. But I have three primary problems with the non-mineral findings of the report. I guess, first of all, as we have talked about a few times now today, it does not consider the substantial property taxes and sales and use taxes paid by all power plants in Wyoming, wind and solar. Everyone pays property taxes and sales taxes except for federal hydropower plants. So if I look at EIA data, there's roughly 55 taxable power plants and roughly 45 plants that are selling electricity. And that difference is because there's some power plants behind the meter. Secondly, I think there's comments they made about projects on federal land don't pay taxes. That is inaccurate. We pay all of the same taxes as it would if it was on private land or state land. All the property taxes are due, all the sales taxes are due, all the generation taxes are due, all the business license taxes are due. And in addition, we do pay the federal fees and rents and royalties, which again, not available at the time of report, but we have been talking about this as a industry and as a committee since 2016. How do we help bring the federal revenue sharing to Wyoming? And so happy that that has happened. So that will now be in place. I think another concern I would have is just that general idea that what's past is prologue, or just because something has happened means it will always happen. We talked a lot today about volatility. Fuel markets are not the same as power markets. I'm always talking about how I don't think we can compare mineral and non-mineral resources. Minerals are always going to win. Railroads, you look at the whole list of industrial non-mineral taxpayers, railroads, pipelines, telecom, none of them approach the amazing revenues that are provided through the fossil fuel industry. So I think, the answer for Wyoming is we can do both and all. We can sell coal as a fuel for power. We can sell coal-fired power. We can sell wind-powered electricity. There's different markets and different use cases for all of these things. You've heard a little bit about how solar is helping bring the data centers to Laramie County and bringing, not only the property taxes and sales taxes paid by those solar power plants, but then the data centers and all the property taxes that those bring and the electricity taxes, which as another, nerdy data point, the fiscal note estimated that all of the sales tax on the retail sale of electricity is about $43.4 million. So if you were to remove that theoretically and place that on 45 taxable power plants, you're basically taking away a tax that is broad-based and applied at the final point of consumption or the final point of sale, and put it on 45 power plants where that tax isn't applied at the intermediate point of production and is no longer transparent to the taxpayer. A sales tax on your retail bill is very transparent. You know exactly what you've paid. If it's buried in the wholesale cost of power that gets buried into everything else that goes onto your bill, you don't see it and you will pay it. Your constituents will pay it. The tax will affect that. And so, I think those are my main issues with the report. It's just kind of dangerous to assume that all power plants that operate today will continue to operate today, that all power plants that operate today will have their same output capacity. The utilities that serve Wyoming have service territories that go beyond the state boundaries. There are parts of Wyoming that don't get their power made in Wyoming. Lower Valley Energy, the vast majority of their power comes from federally subsidized hydropower from the Pacific Northwest. That's why it has the lowest cost of power in Wyoming. They have a few wind farms, but Jackson has one of the lowest costs of power in the entire state because their power comes from outside the state and it's not taxed. The only way that power is taxed is by that sale, the retail sale of electricity tax. So those are kind of my high level thoughts on the report.
Well, thank you for coming.
I appreciate the opportunity and happy to be a resource. So thank you. And I'll get my handouts to the LSO.
We would appreciate that.
Mr. Chairman, one comment on the Snake River or Lower Valley. What's the name of your co-op in Teton County? Lower Valley Power and Light. They're in a very unique situation as they're on the Snake River, and that contributes to the Columbia system. And so they enjoy preference power from the hydro plants in the northwest of the country. So that gives them a lot of flexibility and very low hydro rates, which aren't available to the rest of Wyoming. It's good to know that kind of stuff.
Do you have anybody online?
Yes, sir, Mr. Chairman, we have Scott Johnson with Basin Electric online.
Okay, you all right? Yeah, 1:30. Yeah.
They should be online now, Mr. Chairman.
Mr. Chairman. If I might, the gentleman coming online is with Basin Electric. He's one of ours. And he's mainly coming online to answer any questions. He doesn't plan to give any testimony.
Go ahead and start then.
Okay. All right, will do. Thank you, Mr. Chairman. My name is Sean Taylor. I'm the Executive Director of the Wyoming Rural Electric Association. We represent 11 distribution co-ops all across Wyoming. They're nonprofit, owned by our customers. We are owned by our customers, so it's a little bit different business model than investor-owned utilities. And I'm going to say very little because of our 11 distribution co-ops, we also have 3 generation and transmission cooperatives. They're the wholesale power providers to 10 of the co-ops, the distribution co-ops. One of them is Deseret out of Salt Lake City. They serve Bridger Valley Electric, and I don't believe they own any generation in Wyoming, so this would not impact them. The other one is Lower Valley Energy, which I'll talk about here in a really quick second. The other 9 distribution co-ops are provided power by these folks at the table, so I'm going to let them take it over. But with regard to Lower Valley Energy, yes, they do have the hydropower, but they also own and operate some wind and some of their own hydro. So we're a little bit concerned on what a generation tax would mean to that particular distribution co-op because they are not part of a broader generation transmission cooperative. So I just want to make that clear, and then I'll turn it over to these guys.
Sounds good. Questions?
Good morning, Mr. Chairman, members of the committee. My name is Ryan Norrell. I am the Vice President of Government Relations for Basin Electric Power Cooperative. My colleague Scott Johnson is the tax director for Basin Electric. He is present remotely in case there are any tax particular questions, as Sean had indicated earlier. Basin Electric is a 9-state generation and transmission cooperative. We generate and transmit electricity across 9 states across the West, from the Montana-Canada border down to the New Mexico border, east across the Dakotas, parts of Nebraska, Minnesota, and Iowa. Basin Electric owns and operates Dry Fork Station up in Gillette. We also are a joint owner with Tri-State Electric of Laramie River Station, both coal plants here in Wyoming. We also own and operate 6 small natural gas units in the Powder River Basin as well. We'd like to thank you for the opportunity to address the Revenue Committee on the topic of electricity generating tax options. I was thinking about getting into the weeds of the actual bill that was provided in the HB 300 last session's bill. I'm not going to get too far into that because I know this is a work in progress, it seems. Just wanted to underscore the importance of defining the terms. For example, HB 300 talked about a tax to be levied on gross energy earnings. There was no real definition of what that term was, so it was hard to say what the impact would be to the generator in that circumstance. Earlier, we were talking about gross revenue, but just as long as we are, or gross receipts, I'm sorry, just as long as we're clear about what those terms are. Part of the issue is that if we're talking about sales, as Mr. Bush from Black Hills indicated earlier, electrons, once they get on the grid, they can't be tracked. You're not sure which one's the blue one, which one's the green one, which one's the black one. Similarly, when you got an interstate grid, you're not sure which one's exactly a Wyoming electron versus a Montana versus a North Dakota electron, for example. So you may end up, if you're taxing sales, you might end up inadvertently taxing electron from Montana, for example, Just be aware of just that when we're defining the terms. So asking for clarity on any terms going forward. On a policy note, we just also like to raise, as was raised earlier, that any tax raised would impose a cost added to our taxpayers or to our ratepayers. And even if there is an offset on a sales tax here in Wyoming, that still doesn't mean that the cost of electricity, generating electricity, isn't going up. And that would have to be passed on to somebody somewhere. And as a result of that, in the interstate markets, we would have to take that into account when we are dispatching units to respond as energy is going into the market, which may end up making Wyoming generation a little less marketable and economic to run. We would have to add on the impact of this tax to our generating units. It also may have an inadvertent effect on new generation, new resources that Basin, for example, is looking at a $12 billion capital expenditure over the next decade that does include new generation. And as we look out into the future and project different areas where we would need new generation and what resources are most economic to build, we would have to take that tax into effect or into account. With that, I stand for any questions. I do want to just also mention, we have had very constructive conversations with LSO in the past on this, and we stand as a resource for LSO in going forward. I'm happy to engage in those continued conversations in the future and happy to take any questions.
Representative Lean.
Thank you, Mr. Chairman. Thank you for coming today. My question would be, could you please get with LSO and get us what would be considered competitive rates, given that you have a multi-state industry sitting in front of us?
Mr. Chairman, Representative Lean, yes, we will.
Representative Campbell.
Thank you, Mr. Chairman, and thank you guys very much for coming here today. I keep hearing that energy is energy, but at the same time, I'm hearing, and as a former salesman myself, I understand that the customer is always right. But when we have customers that are dictating we want green energy, but we don't want it in our backyard, we want Wyoming to do it. So there is a certain trade-off. Talking as far as your customers' rates, I think that there is a trade-off for them enjoying not having the wind turbines and the solar panels in their view sheds. You guys have, my question back to Kara, you guys have sustained and adapted going through the current market situations. On the green end, how you guys are offset enough to where you guys can balance it out. Have you factored that into your long-term strategies? Thank you.
Mr. Chairman, Representative Campbell, yes, Basin is an all of the above generator, and we have the ability, as you indicated, to balance our own renewables. Basin, however, is uniquely situated. We have a great resource in the Powder River Basin. We have another great resource in the Bakken area of North Dakota. We have access to natural gas, to coal bed methane, to coal, both in North Dakota and in Wyoming, which helps us from a long-term perspective. Our planning, for example, we're looking out to 2040. We do not see any closures of any of our plants, nor of any of our renewables, which we own and operate 2 wind farms, one in each of the Dakotas. Those we don't plan to retire anytime soon. We plan to repower those. And to your point, yes, we're able to balance those, and our balance sheet looking forward for the next 25 years or 15, 20 years is taking that into account.
Follow up.
Thank you, Mr. Chairman. Thank you, guys. That's kind of what I'm looking at. I'm trying to figure out, because I mean, we're looking at the long-term interest to where you guys have a balanced portfolio to where you fit in here, where I'm looking at some that are not quite as balanced. And I just want to make sure that, you know, as we proceed, that we're going to get what we're planning on getting, I guess would be the best way to say it. Thank you. Thank you very much for your time, sir.
Thank you.
I have a quick question.
Yes.
What's the average lifespan of a windmill?
I don't have that answer right off the top of my head. However, I can tell you that our repowers that we're doing in the Dakotas right now, those units came online, those wind farms came online in 2010, 2011. And we are doing a voluntary repower at this point with more efficient turbines that generate a little bit more electricity at lower wind speeds for us. And we're expecting to get at least another 15 to 20 years out of those turbines as well.
Thank you. Co-Chairman Locke.
Thank you, Mr. Chairman. Quick question for you. You do have a balanced portfolio, but not in Wyoming. You don't do wind in Wyoming. Is that accurate?
Mr. Chairman, Representative Locke, that is correct. We are exclusively coal and natural gas in Wyoming.
Okay, thank you.
Thank you.
Thank you, Mr. Chairman. My name is Austin Rodemaker, and I am a government relations advisor for Tri-State Generation Transmission Association. We are a 40-member G&T cooperative across 4 states, and we serve 8 of Wyoming's distributive cooperatives with wholesale power, making us the largest cooperative footprint for power in Wyoming. We appreciate the efforts being made to optimize energy and utility tax policies. We based a lot of this testimony off 25 LSO 0561 or House Bill 300 from the past session. You know, the numbers weren't exactly extremely clear about where this would land, and so we're still kind of working through some of that. But with that understanding, we cannot and would not support any legislation that results in an increase in rates to our member cooperatives and subsequently on to their ratepayer customers. We also share the same concerns that Basin mentioned about hindering any pursuits of competitive resource development in Wyoming. Currently, Tri-State really only has a share of Laramie River Station, so really the only generative capability that we have coming out of Wyoming is coal at the current moment, but we are always looking for opportunities to further create generation as electricity demands continue to grow. In addition with that, Tri-State has an approved FERC tariff called Bring Your Own Resource that allows our members to develop some of their own generation, and we currently have filed an adjustment to that tariff to increase the flexibility for our members. So we have concerns that if our member systems are interested in creating their own generation moving forward, that this could create a non-competitive environment for them as well. Part of that comes into the self-sufficiency aspect of this. As we are seeing large loads come into the state, we want to provide the easiest path forward for any large customer that comes online. With that being said, we'll continue to follow this concept closely, and we are always available to answer any questions. And with that, Mr. Chairman, I'll stand for any questions.
Representative Campbell.
Thank you guys again. Thank you, Mr. Chairman. I'm just wondering, I'm hearing how detrimental that if Wyoming was to do a rate hike, that is. How does Wyoming's exemptions that you guys get? Because there's a great deal of benefit that you guys get from the state of Wyoming. How does that balance out? Have you guys looked at the exemptions that Wyoming gives as an advantage that you have over other states? How does Wyoming compare to other states when it comes to all the exemptions and carve-outs that benefit your industry? Thank you.
Mr. Chairman, Representative Campbell, as far as I know, we don't receive any exemptions. I mean, if we were to, because we only have coal, and then we have our distribution co-ops that own and operate the distribution lines and substations, but I'm not quite sure which exemption you're referencing.
Follow up.
Thank you, Mr. Chairman. Pretty much any industrial industry, all new, we don't charge you for any new equipment on manufacturing or upgrading your system. There's I don't know, I don't have the whole list. That's part of the reason why I think we're having this conversation, is we're trying to put all these exemptions holistically together to where we as a body can look and see, why are we so competitive? Everybody and their brother wants to do energy in Wyoming. There is a reason for that. And I'm just wondering how we compare with other states as far as the taxation and other fees that would be encumbered in your industry? Thank you.
Mr. Chairman, I'll try and run some of that down. The only exemption that we have doesn't have to do with taxes. We're exempt from rate regulation by the Public Service Commission because we're self-regulated. That's the only exemption that I know of that the co-ops at least have.
Representative Riggins.
Thank you, Mr. Chairman. Gentlemen, you'd mentioned about customers and generating their own power. Do you guys have some general guidelines or policies that kind of suggest, well, we don't mean like a 10, 15 megawatt supplementary, or do you have any ideas or people present things that are fairly large that would be part of that infrastructure?
Mr. Chairman, Representative Riggins, so Tri-State had, when we're talking about this, our member systems developing their own generation, it goes through a process, right? So essentially they're bidding into a system with Tri-State about whether or not this generation that they are potentially looking at would be competitive on the market. So how the process works is that take Cooperative A, who's a member of Tri-State, they build a generation site. They then sell that power back to Tri-State for Tri-State to shoot throughout anywhere in their system. So they bid into a process with us. So the size of it doesn't really, that's part of the bid process, but it doesn't hinder depending on what size it is.
Follow up.
Thank you, Mr. Chairman. Yeah, I mean, I didn't realize, I thought maybe you was talking individual customers, but you're talking the actual, your member subsidiaries or something like that, so.
Mr. Chairman, Representative Reed, that's correct. It would be a cooperative system that's bidding through this process, not an individual customer.
All right, thank you.
Representative Lean.
Thank you, Mr. Chairman. My question is around coal. The way the bill is structured, you currently would receive a credit for any severance taxes that are paid. Would that in theory offset the costs that would then go in place?
Mr. Chairman, Representative Lean, that's a great question. And that's what I talked about when we talked about we weren't sure where the numbers were going to land on this is we see that there's a credit in there. And given that all we have is coal, we understand that could potentially offset, but if the sales tax isn't at the same level, right, there's a potential that it could increase rates. And obviously as a co-op, right, it's a not-for-profit structure. We don't make any additional money any which way. So our goal is always reliability and affordability as our two main focuses. So, that's why I said we're not sure where the numbers are going to line up. But that's why I've just made more of a general statement of anything that would increase rates we're not going to be in favor of.
Anything else?
Mr. Chairman, if I may, in response to Representative Campbell's question about other states, just for your awareness, North Dakota does have a coal conversion tax, which covers the output and generation of coal electricity in North Dakota. There's also a similar production and output tax on gas in North Dakota as well.
Well, thank you, gentlemen.
Mr. Chairman,
Yes, Senator Case.
if you think about it, one reason why you might want a gross receipts tax rather than a per megawatt hour tax is that the deductions apply to the whole company, the credits they would get. And so it wouldn't change the marginal dispatch order of their resources. So that, the cheapest would go first and so it's not gonna, whereas the issue of the $1 per megawatt hour on wind, for example, does slightly change the competitiveness of wind in the market. So when it comes up for dispatch, they got to worry about having to pay that tax. Gross receipts, it kind of solves that problem. It was mentioned from the gentleman that they're mostly coal and natural gas fired. Those are going to be the biggest credits would be your coal and your mineral taxes paid. So the chances of them paying any other tax at all are nil. We wouldn't do that. We'd be penalizing our coal plants and everybody else if we had the tax rate that high. So we got to kind of think this thing through. Thanks.
Okay, Representative Worf mentioned having LSO write a bill. Did you get good notes on that, Josh?
Mr. Chairman, I might need a little more direction on what that request was.
Representative Worf.
Thank you, Mr. Chairman. Yes, Josh, what I was looking at is, a bill that would actually set up a tax rate for each type of electricity that's generated, whether it's wind, solar, basically breaking them all out, and looking at what a tax rate would be for each type of electricity that's generated, whether it's green energy or the other coal or natural gas.
And so, Mr. Chairman, a clarifying question, would you be looking at based on a megawatt hour or on the gross receipts?
It makes more sense to me to do megawatt hour, but I don't know what the committee, I mean, this is something what would the committee like it to look like? I don't know which would be better, the gross receipts or the megawatt. Megawatt to me is what we talk. So that's probably what I would go with.
Representative Lean.
Representative Worf, my question is, do you want them to be different taxation costs, or do you want them to all be uniform?
Mr. Chair, I threw this out for the committee. I think the committee should talk about it, but to me, I do think that's one of the things we're trying to do is make things equitable, which it's difficult to do because they all have different costs associated with them. And, some of the industries are getting, they get benefits from the federal government. They're underwriting some of it. But I think we should look at what we would recommend the tax be on those specific items. I'm just looking at the ability to differentiate, what we're selling stuff for. We're exporting energy, and I think we should decide at what rate we want to tax the green energy versus kind of the traditional energy that's produced in the state, if that makes sense, Josh.
Maybe
So, Mr. Chairman.
we're not close to writing a bill on this.
So, Mr. Chairman, just one comment. So the bill that was in your packet, the bill from last year, House Bill 300, so it would tax all types of electricity uniformly, regardless of the production source. And then it would also give credits based on other taxes paid. So to the extent that structure would somewhat equalize the electricity regardless of source, that might be on the track of what you're discussing, Mr. Chairman.
Mr. Chairman, that is what I'm looking for.
Well, if we have time, we'll dig into House Bill 300. If not, we'll push it off to the next meeting.
And I'm fine with that too. I'm fine with doing it next meeting if we need to.
Representative Riggins. Representative Lean.
Mr. Chairman, I would request that we repeal the nuclear exemption regardless of whatever format we move forward with, whether it's House Bill 300 or a new draft, that be a portion of it.
I would second that.
I would third it.
All in favor? Aye. Opposed? Josh, I think that'd be an easy, simple bill, and it should be standalone. Because it'll fit into any of the others, right?
Yes, sir, Mr. Chairman. We could do it either way, but yeah, if you want a standalone bill, I could make that happen, Mr. Chairman.
What's your suggestion?
If you wanted to combine with another bill draft, you could probably do it that way too, but as of now, I'll do it as a separate draft.
Thank you.
Mr. Chairman, I think that works well. Another thing we could do is to actually repeal the tax on wind energy, get rid of it. Because comes into the gross receipts tax as a credit, dollar for dollar credit. They pay this, they would take it off their gross receipt bill. So we're always penalized for having the wind tax. We get rid of it. And it wouldn't change the dollars at all. And it would eliminate the $1 penalty that sometimes happens in dispatch order. So, and we could do that later. We could add that to the bill, the 300 bill, but it really works. It doesn't mean they're going to pay any more or any less. It just gets it off the books.
Can we capture that as a topic, House Bill 300 for our next committee meeting?
Mr. Chairman, if that's the request of the committee, I can certainly redraft House Bill 300 as a new draft for consideration for the committee.
Does everybody understand what we're talking about?
You bet. And we could divide that out, Mr. Chairman, and do it or not do it. It doesn't, we can talk about it then.
So we're gonna work on a bill draft of 300 with said changes. All in favor, say aye.
Aye.
Opposed? There we have it. Okay, I guess we will break for lunch.
And then, Mr. Chairman, just about way of scheduling the afternoon. I don't think that topic of combining sales and use taxes under one deal, that's not going to take very long. That's really a simple, straightforward thing. There's 2 hours on the agenda for that. So if we think about that, we could get some time this afternoon. And we're not doing too bad, better than yesterday.
I think, yeah, and we've covered combining them. And it's 98 or 99.8% exactly the same.
10-minute bill.
Yeah. So we'll work on that first. It should be quick, and then we'll get into the other legislation. Be back at 1:30.
Mom's gotta be back soon.